you could hover your cursor over the thumbnails at the bottom of your screen.
The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. Before we begin today's hearing, I want to remind members of a few matters, including some required by the regulations accompanying House Resolution 965, which established a framework for remote committee proceedings. First, I would ask all members on the WebEx platform to keep themselves muted when they are not being recognized. This will minimize disturbances while members are asking questions of our witnesses. Members on the WebEx platform are responsible for muting and unmuting themselves. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members on the WebEx platform are reminded that they may only attend one remote hearing at a time. So if you are participating today, please remain with us during the hearing. Members should try to avoid coming in and out of the meeting, particularly during the question period. If during the hearing, members wish to be recognized, the chair recommends that members identify themselves by name so as to facilitate the chair's recognition. I would also ask that members be patient as the chair proceeds, given the nature of the online platform the committee is using. In addition, the chair informs the members participating in person that in enforcing order and decorum in the hearing room, the chair has a duty to protect the safety of members. The attending physician provided the following guidance. For U.S. House of Representatives meetings in a limited enclosed space, such as a committee hearing room, for greater than 15 minutes, face coverings are required. Accordingly, the chair will treat wearing masks as a matter of order and decorum, and all members should wear masks. The chair has a strong preference for members to wear masks even while recognized. Members who do not wish to wear masks may participate virtually through the WebEx platform. Today's hearing is entitled Protecting Consumers During the Pandemic, an examination of the Consumer Financial Protection Bureau. I will now recognize myself for 5 minutes to give an opening statement. I would like to welcome Director Kraninger to what I hope will be her last appearance before this committee as CFPB Director. 10 years after we passed the Dodd-Frank Act to end the predatory and discriminatory practices that caused the financial crisis, we find ourselves in the midst of an economic and health crisis caused by incompetence and exacerbated by narcissism that will once again hit the most vulnerable Americans the hardest. The scale of the crisis is unprecedented. Today, we learned from the Bureau of Economic Analysis that the gross domestic product, that is the GDP, decreased at an annual rate of 32.9% in the second quarter of 2020, which is the largest drop ever recorded. Our consumers need a strong consumer bureau that provides robust protections on their behalf and holds financial institutions accountable when they commit abuses. A record number of people have filed complaints about financial institutions with the CFPB during the COVID-19 crisis. We know that consumers are reporting major hardships in working with payday lenders, mortgage services, credit card companies, and the credit reporting bureaus. They're reporting long wait times, inconsistent information from consumer representatives, and a lack of follow-up. Unfortunately, I witnessed today Consumer Bureau Director Kathy Kraninger has done nothing, next to nothing, of substance about any of this. Instead, she has focused the Consumer Bureau on weakening critical consumer protections, relaxing enforcement against financial institutions, and undermining the agency from the inside. Director Kraninger, let's review some of the harmful actions you have taken since March when the pandemic began. You issued a final rule rolling back key safeguards for payday, car title, and installment loans, exposing consumers to high-cost predatory loans. It is shameful to open the floodgates to predatory loan products that trap consumers in a cycle of debt at any time. But to do so during a pandemic is egregious. It is hands down the most anti-consumer action you have taken as director, and given your record, that's saying a lot. You also weakened the reporting requirements under the Home Mortgage Disclosure Act, willfully hindering the ability of the Consumer Bureau researchers, journalists, advocates, and the public to detect redlining and patterns of discrimination in mortgage lending. An investigation by Reveal News found evidence of modern-day redlining in 61 metropolitan areas across the country. Using the public data set, you are now degrading. It is deeply irresponsible and malicious to undermine this important tool. In addition, you have issued an advance notice of proposed rulemaking to make substantial changes to the agency's qualified mortgage rule, which is a rule implementing the standard that lenders first demonstrate that a borrower can repay a loan before signing the mortgage documents. It is unfortunately all too fitting that you seek to undermine this standard on the 10-year anniversary of Dodd-Frank. You may not remember the financial crisis, but I and the members of this committee do. We included this standard in Dodd-Frank because the proliferation of unaffordable and predatory mortgage loans was a central driver of the 2008 financial crisis and caused millions of families, and especially borrowers of color, to unfairly lose their homes. These actions are just the latest that you have carried out to sabotage the very agency you have been entrusted with leading. Your actions are a betrayal of the consumers you are tasked with protecting consumers better. And so, having said that, I'm a little bit disturbed that I'm missing the television portrayal of the funeral of John Lewis with magnificent speakers there today. But, you know, we have to carry on with the business, and I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes for an opening statement.
Well, thank you, Madam Chair. I would say the majority schedules the timing of these hearings. But the partisan nature of the Chair's opening comments, I think, belie the broad unseriousness of our current politics in the midst of this pandemic, sadly. But, Madam Chair, I want to welcome Director Kraninger for the first of what I hope are many appearances before the committee in the coming years. If I were not wearing a mask, you'd see that I say that with a smile and an attempt to be lighthearted in the midst of what is a pretty disastrous political discussion we're having here in Washington. So look, committee Democrats are asking questions. Is the CFPB protecting consumers both during and outside of the pandemic? And if you look at the facts in a fair-minded way and recent actions by the Bureau, I can safely answer my colleagues' questions. Yes, they are. Despite what the Democrats say to score political points, this CFPB, under your leadership, Director Kraninger, has worked diligently to provide resources, guidance, and protection for consumers most at risk in these unsettling times. The Bureau has encouraged financial institutions to work with borrowers, provide increased flexibility for supervision and enforcement activities, clarify guidance to mortgage servicers to comply with CARES Act forbearance requirements, create an elder fraud prevention and response network development guide, release an updated COVID-19 consumer complaint data bulletin, outline the roles and responsibilities of credit reporting companies and furnishers, create a consumer relief guide for mortgage payment forbearance and foreclosure protection. Pretty damn good work, I must say. And at the same time, keeping your workforce safe. These are just a few of the CFPB's pandemic-related initiatives. Apart from its response to the pandemic, this Bureau, under your leadership, has approached difficult and polarizing topics with a steady hand over the last year and a half, and I want to thank you for that. You've increased clarity in the market for consumer lending. One example is the Bureau's recent rulemaking to revise the 2017 small dollar lending rule. We know that small dollar loans are a lifeline for millions of Americans in need. They help consumers cover unexpected expenses or income shortfalls during periods of economic stress like we're currently experiencing now. The decision to revise that 2017 rule is a necessary step to increase clarity and access in a market that serves millions of Americans trying to make ends meet. We must continue to review and right-size burdensome regulations that inhibit lending into the real economy at a time when the American people need it most and can least afford that inhibited lending. Lastly, Director Kraninger, as we've discussed in the past, my colleagues and I believe you have too much power. The structure of the Bureau is unchecked by Congress and the President, and and you even agree with me on that consistently before your confirmation, after your confirmation. And since Dodd-Frank's enactment, Republicans have argued the Bureau's structure is unconstitutional. The funding mechanism leaves it unaccountable to anyone. This past June, the Supreme Court agreed with what Republicans have been saying all along. In striking down the structure created by the Democrats in 2010, the Supreme Court found the director holds too much power and violates the separation of powers. We now have a real opportunity to work together on necessary statutory reforms to the Bureau. Reforms that will benefit consumers and bring clarity and clear guidance. Leader in that effort is my colleague and friend, Blaine Lukemeyer. And Director Kraninger, I want to thank you for your leadership and want to yield the balance of my time to fellow ranking member Lukemeyer.
Thank you, Ranking Member, and thank you, Director Kraninger, for being here today. Just a few weeks ago, the Supreme Court confirmed the unconstitutional structure of the CFPB by ruling the CFPB director can be fired at will by the President of the United States. The structure and unprecedented authority of the CFPB have turned it into a political football that will no doubt swing back and forth on the political pendulum, creating uncertainty and confusion for financial institutions and consumers for decades to come. That's why I've introduced legislation to change the leadership structure of the CFPB from a single director that can be fired at will to a bipartisan 5-member commission. Just last Congress, this legislation enjoyed bipartisan support in this committee. However, in the 116th Congress, this common-sense solution has only garnered support from my side of the aisle. Changing leadership structure and increasing government oversight of the CFPB are vital to protect businesses and consumers. I look forward to discussing these issues with you today. With that, Madam Chair, I yield back.
It is now time to hear from Director Kathy Kraninger. Director Kraninger has testified before the committee previously, and I believe needs no further introduction. Without objection, your written testimony will be made part of the record. You will have 5 minutes to summarize your testimony. When you have 1 minute remaining, a yellow light will appear. At that time, I would ask you to wrap up your testimony, respectful of the committee members' time. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, members of the committee, thank you for this opportunity to provide you with an update of the fantastic work the CFPB has been doing since last we met. I appear before you as the country is engaged in a national conversation on racial inequality and confronting the unprecedented pandemic. Today, I'd like to discuss both of these topics with you. Under my leadership, the CFPB is taking steps to help create real and sustainable changes in our financial system so that African Americans and other minorities have equal opportunities to build wealth and close the economic divide. Earlier this week, I authored a blog outlining the Bureau's important fair lending work. We also issued a request for information on how best to create a regulatory environment that prevents credit discrimination in all aspects of the transaction and expands access to credit. The information that is submitted will help us enforce the Equal Credit Opportunity Act, or ECOA. Among the topics the public can comment on are how to better protect consumers with limited English proficiency, as well as applicants who derive income from any public assistance program. I encourage the public to respond so that we can build a financial system that treats everyone fairly and provides clear rules of the road. Having clear standards helps us identify any violations in fair lending laws. Recently, the Bureau filed a lawsuit alleging a lender had violated ECOA by discouraging African Americans from applying for loans through its advertising. The Bureau also announced a settlement last year with a mortgage corporation that violated the Home Mortgage Disclosure Act and Regulation C by intentionally submitting years of mortgage loan data that contained errors in the fields of race, ethnicity, and sex. Since my last testimony before the committee, I have requested critical authority from Congress to allow the Bureau to compensate whistleblowers. In our enforcement work, we have seen firsthand that whistleblowers can provide key information on fair lending violations. I want to thank Congressman Green for introducing legislation similar to what I requested. I stand ready to work with Congress to secure this important authority. Now let me take a moment to discuss how we are protecting consumers during the pandemic. We have worked to expand our reach to consumers to provide them with actionable, useful information about their rights, options, and expectations in the market for consumer financial products and services. We have produced over 70 blogs and videos that have been accessed directly by more than 3 million users. Through our social media reach, staff estimates our materials have been sent to 41 million unique users. These materials are available in 7 different languages and have been constantly updated to adapt to the changing dynamics. We have also promoted our consumer complaint system. When consumers submit complaints to the Bureau, they help inform our work in supervision, enforcement, regulation, and education. Specifically, in response to complaints and other markets and stakeholder feedback, we worked with interagency partners to quickly address a student loan-related credit reporting issue, as well as CARES Act mortgage forbearance lump sum payment concerns. From January 1st through July 26, 2020, consumers have submitted more than 270,000 complaints to the Bureau, of which more than 14,000 complaints specifically referenced coronavirus. Each month from March through June set a new monthly record for complaints. Our Consumer Contact Center and our online portal have operated efficiently and effectively throughout the pandemic to take those consumer complaints and refer them to companies for response and ensure those responses are received. We also partnered with other federal agencies to develop and launch a unified housing website to provide consumers with comprehensive and accurate information on their rights during this time. The Bureau has also developed a new targeted supervisory approach called prioritized assessments to focus on those markets and institutions that pose the greatest risk of consumer harm as a result of pandemic-related issues. We remain fully engaged in the execution of the Bureau's critical mission, including continued progress on our regulatory agenda, which is relevant to the pandemic and ultimate economic recovery, as well as our supervisory and enforcement work. We work closely with partners and stakeholders, recognizing the important roles that others play in supporting our consumer protection mission and preventing harm. I am particularly proud of the Bureau's staff's excellent work during these challenging and unprecedented times. And thank you again for allowing me the opportunity to testify today. I look forward to the questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Director Kraninger, under your leadership, the Consumer Bureau has brought fewer fair lending enforcement actions, rolled back consumer protections against predatory payday lending, scaled back HMDA data used to combat discriminatory practices like redlining, and engaged in inappropriate personnel practices, such as allowing political appointees like Thomas Ward to burrow into the agency and take what should be a nonpartisan career position, and hiring Eric Blankenstein, who was well-documented racist views, and Paul Watkins, who was affiliated with an anti-LGBTQ hate group. Director Kraninger, following the financial crisis more than a decade ago, Congress determined that consumers needed an agency solely dedicated to protecting them from the abusive practices and products that contributed to the crisis. When Congress passed Dodd-Frank and created the Consumer Bureau, we clarified the rules of the road and asked the agency with enforcing the law, the agency with enforcing the law and protecting consumers in the financial marketplace. The pandemic has only heightened the need for the Consumer Bureau to protect struggling consumers. Unfortunately, the Consumer Bureau has engaged in deregulation without facts or reasoning and seems to be protecting the interests of industry over the interests of consumers. Director Kraninger, what proactive supervisory and enforcement steps has the Consumer Bureau taken to protect consumers who have lost income due to COVID-19 and are struggling through no fault of their own? How are you utilizing the authorities at the Consumer Bureau's disposal to protect consumers against bad actors that are taking advantage of our communities during this crisis? What have you done?
Chairwoman, our supervisory and enforcement work continues through the pandemic. I'll stay briefly about supervisory actions because I think it's a very different approach than we've had. Typically, examiners go to an institution and look at loan files from 2 years ago and assess compliance against the law, which is important. We instituted, as a result of the pandemic, a prioritized assessment process. We are going to hundreds of institutions across the spectrum and a risk-based approach to look at what they are doing with respect to the pandemic. What are their operational challenges? Are they following the guidance to accommodate their customers? Are they following the CARES Act processes? Are they providing clear information to consumers? And we are looking to, again, prevent consumer harm by addressing that right at the issue and right at the point where that activity
Director
is happening.
Kraninger, after you do all of those reviews and ask those questions, then what do you do?
Chairwoman, if we find violations, we will act on them. But I will say that the vast majority
Give us an example of one of those corrections you have taken.
I'm sorry, Chairwoman, I didn't understand that.
After you have done your reviews, making sure that people are doing what they're supposed to do, when you find that they have not been doing it, what do you do? And give us an example of one that you have taken care of.
Well, that is a confidential process through the examinations, but we do get restitution for consumers through supervision. There's a bunch of examples in the semi-annual report of the amount of restitution that's been gotten through supervision. We also, certainly if we believe there are bad actors or if this is a sustained issue with respect to violations, that's referred to enforcement. We also independently take in enforcement actions, and in the pandemic, we have been incredibly active with all of our law enforcement partners, from state attorneys general to the Justice Department and the FTC.
Director Kraninger, are those enforcement actions that you have taken available to members of this Congress? Can we see what you have documented that you have done when you have done your reviews and discovered that you have people in departments that are not doing what they're supposed to do? Can we review what you have done?
Yes, Chairwoman.
Well, thank you. Let the record indicate that the chairwoman is interested in reviewing actions taken by the director of the Consumer Financial Protection Bureau after she has done reviews where she has determined that those who have not been following the rules, the laws, the procedures, etc., we can understand exactly what she has done. So, also, while I have a few minutes here, consumer complaints during the COVID-19 period have surged. Nearly half of all complaints, 46%, were related to credit reporting. Nevertheless, in April, the Consumer Bureau announced that it would allow much greater flexibility in how long credit reporting agencies may take to investigate consumer report disputes. Do you think it is appropriate for the Consumer Bureau to announce that it would weaken enforcement of the Fair Credit Reporting Act's requirement that credit reporting agencies like Equifax investigate disputes in a timely fashion? My time is up. You do not have time to answer that. I will submit that question and answer, and we'll submit it to you for further answers. The gentleman from North Carolina, Ranking Member Mr. McHenry, is recognized for 5 minutes.
Well, thank you, Director Kraninger, for being here, and thank you for managing this process. I know it's awkward to speak with a mask on and to sit behind effectively a salad guard or whatever those things are that you're behind. but we're trying to do our best. And there are a couple broad things I want to talk about. Obviously, the Supreme Court decision, which is something I brought up in my opening statement. You consistently said you believed that the director is given too much power. Congress should remedy this. And I appreciate the fact that you have continued to have that same view, even though you have this enormous power and the sort of lax accountability standards as well. Has your view of your role shifted since the Supreme Court decision?
Congressman, certainly we reviewed the case. I was very gratified that the Supreme Court took up that case and made the decision on it. It's created a lot of uncertainty in the agency's enforcement actions and around the agency's mission, and I think that is incredibly helpful to the process. I will say, with respect to additional changes on structure or otherwise, I leave those in the hands of Congress. To the extent that you all decide to make changes on that and that law becomes law, we will certainly work to institute those changes.
I also mentioned the small dollar lending rule. There are details of this that I agree with. There are details of it that I disagree with. But why did you take the action on the small dollar lending rule?
So, Congressman, there was a lot of concern. Frankly, we were in litigation over that rulemaking. There was a lot of concern about the dramatic impact that would have on the availability of small dollar credit. We know there is significant demand and need and interest in small dollar credit. That's been documented, and Congress has even taken actions funding a small dollar program through CDFIs. So trying to promote competition in that space is an important aspect of it, and there were a lot of issues with respect to the payday rule that were undermining that. Most pointedly, though, we followed the Administrative Procedures Act and noted and documented that the initial rule did not have the robust evidence and legal basis given that dramatic impact on small dollar credit availability. So
there's benefit in terms of credit availability and benefits for certainty, right? Regulatory certainty. And so that will have a positive impact for consumers and their access. Will you continue to ensure that there's diligent oversight of the industry?
Absolutely. Our enforcement actions have continued apace in this industry, as in others. We know there are bad actors in every market, and so we will continue to enforce the law and engage in examinations of payday lenders, which we have done. But in addition to that, we're doing work on disclosure testing to ensure that consumers do understand this product. There's a lot of evidence that they understand it, but let's actually continue to do the disclosure testing as well. So a lot of different aspects of this. So,
Director Kraninger, I want to thank you for reviewing Section 1033 of Dodd-Frank, reaching out to the industries about this and consumers. And that section focuses on consumers' ability to access their financial information. I know Congress, we want to do our work for data privacy for our jurisdiction. I think there is consensus between all parties on the need, and then we can dial down in terms of changes. But this statutory requirement is interesting in light of the massive change that's happening in banking. And the feedback you've gotten. For example, fintech companies offer improved personal financial management, faster loan underwriting, and better payment services. And those are positive developments. They are. And I want to make sure that we continue to foster that exact sort of innovation. Is that the reason why you're undertaking this? What are the benefits for a review of the regulatory framework?
No, that is certainly one key priority and principle of the activity is continuing to promote innovation in this space. And we had a symposium just a few months ago to talk through this issue and bring experts together. It was truly a robust conversation. The agency has allowed the industry and all stakeholders in the public to continue to take advantage of those innovations in the marketplace. But we're at the point now where we really should examine the way in which that data transmission occurs, and that's why we're moving to an advance notice of proposed rulemaking.
And let me close by saying thank you. You've been a good public servant, and you continue to act in accordance with the law and have been open to feedback, and I appreciate that. Very much appreciate it. Madam Chair, I ask unanimous consent to insert into the record 2 letters. The first is a July letter to the to the Financial Services Committee from the Consumer Bankers Association, articulating a number of thoughts on the CFPB's rulemaking and actions. And the second letter is a July letter from the Association of Credit and Collection Professionals, opining on the CFPB's rulemaking as it relates to the Fair Debt Collection Practices Act.
Without objection, such is the order.
Thank you, Madam Chair.
Gentlewoman from New York, Ms. Velasquez, is recognized for 5 minutes.
Thank you, Chairwoman and Ranking Member, for having this important hearing, especially at this time. Director Kraninger, earlier this month, the CFPB finalized its revision to the payday lending rule, stripping out a key provision of the original rule developed by Dr. Cordray, the ability to repay requirement. Do you believe the Bureau's revised rule will leave low-income borrowers and those of color more or less protected from unscrupulous payday lenders during this pandemic?
Congresswoman, the mandatory underwriting provisions were having the impact of a substantial reduction in the availability of small dollar credit for all communities, and particularly the communities you mentioned and vulnerable communities who are really in need of access to responsible products for small dollar loans. And that was the primary consideration. The protections continue with respect to the payments provisions.
I hear you. I disagree with you in terms of access to credit. Basically, you know, the smaller of the financial institutions are the ones that are providing loans to individuals and small businesses. So how would you respond to the president of the Center for Responsible Lending, Mike Calhoun, who said that the pain caused by the CFPB gutting the payday rule will be felt most by those who can least afford it, including communities of color who are disproportionately targeted by payday lenders?
Congresswoman, the availability of credit and that rulemaking did have a broader impact. The number of banks that are issuing small dollar products was substantially limited. There are a number of reasons and factors for that.
You're saying that Mr. Calhoun is wrong, that you're right. Director Kraninger, a review of the CFPB's consumer complaint database shows that consumer complaints have risen dramatically since the start of the pandemic. However, CFPB rules still allow companies up to 60 days to respond to a consumer complaint. Given the rising number of complaints and the economic uncertainty many individuals and households are facing, why has the CFPB not sought to shorten this response time?
Congresswoman, I should off the top of my head have the average response time, but it is substantially shorter than that. I believe we're basically at a week for most turnarounds. The 60-day allowance is really because some of these are more complicated issues in terms of what the complaint is and making sure it is addressed. So I think we have a fantastic record of actually getting a meaningful response.
But why not shorten the 60-day requirement or the 60 days timeline? Given the fact that consumers are suffering in this country. These are people that are in trouble right now. Why can you not shorten the 60 days?
Congressman, the vast majority, and we'll get back to you with an actual number.
It would be great to have some empathy. Director Kraninger, mortgage-related concerns represented the highest percentage of COVID-related complaints received by the Bureau. Earlier this month, we held an oversight hearing in which we learned that some mortgage servicers are failing to notify borrowers of their right to forbearance under the CARES Act. Is the CFPB concerned that some servicers are failing to accurately represent borrowers' rights under the CARES Act? How is the CFPB working to address this issue?
So we have produced a significant amount of material in cooperation with HUD and FHFA, scripts for servicers so they have very clear messages that they are supposed to provide to their customers. We've done videos for customers, and in fact, many of the servicers are pulling the information off the CFPB's website and sending it to their customers in multiple languages. This is all available.
Do you have any data as to any complaints coming from individuals who feel that they are not, their rights have not been protected?
There were complaints right around CARES Act passage about concerns about being able to pay their mortgages and concerns about the messages that they were getting. We acted expeditiously, really, those March, April complaints, and addressed them through a lot of different actions, and they have gone down substantially since that time. We're certainly still monitoring, and if we see an increase or if we see any bad action, working really closely with FHFA, actually, we're looking at all of this and we're acting.
Thank you.
Thank you. The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and welcome back, Director Kraninger. I want to just first thank you for your service to our country and for your service to all the consumers in Missouri's 2nd Congressional District. I appreciate your leadership now, and I look forward to it in the future. Before I begin my questions, I also wanted to thank you for all the work that you have done to not only increase transparency at the CFPB, but also streamline and tailor regulations to better protect and provide, I think, clarity for consumers and the private sector. So thank you for that. While I'm proud of your efforts to increase transparency and accountability, the CFPB issues regarding its structure go beyond that of any one director. Now that the Supreme Court has made its decision regarding the structure of the Bureau, it is time for Congress to work together to put the Bureau on a budget overseen by Congress and to run by a bipartisan board. Director Kraninger, would you please discuss how the credit reporting provisions in the CARES Act are working to protect consumers who have been impacted by COVID-19?
That is a very important issue, and I think we're in a much better position than we were after the financial crisis in recognizing the importance of the credit reporting system and our ability to act very quickly on issues as they occur and address them so that they don't impact consumers. The CARES Act provision, of course, requires that those who are affected by the pandemic be reported as current when they're in a forbearance program under the CARES Act, and that is something that we are monitoring. I mentioned earlier the prioritized assessments. That includes a constant presence that the CFPB has with the national credit reporting agencies. We are looking at specifically what they're doing with the information that comes in. We're also doing examinations of furnishers on the other side to make sure they're reporting the right way. Of course, current is not the only thing that is in the data that gets transmitted by the furnishers. So there are a lot of different details about how precisely you continue to comply with FCRA in terms of accuracy and otherwise. But we are all working very closely together to keep that intent of Congress implemented.
Recently, the Bureau announced that it would be issuing an advance notice, I believe is what it's called, an advance notice of proposed rulemaking regarding consumer authorized access to financial records. How does the Bureau intend to address privacy and security concerns in an environment where many unregulated or under-regulated companies are eager to, as we know, obtain and resell consumers' financial data?
So Section 1033 is of course, what you're referencing, and Congress anticipated there might be a need for rulemaking. We're still looking at that. The primary driver is that consumers should be the ones who authorize the data use, but to your point, privacy and security issues are intertwined with that and incredibly important. The means by which many of the data aggregators have been accessing that data is by consumers providing their banking credentials. And that, of course, means then the entity can go in and screen scrape the data and take it out. That has caused a lot of concern by those who believe they're stewards of that data. So we have a lot of technical data access issues there with respect to how that happens. And it will be we have not pre-decided there needs to be a rule, but it will be a challenging rulemaking to take precisely the privacy, security, make it lasting so that it doesn't change based on technology changes as well. Yeah, but we're really looking to do that right.
I think so too. How will the Bureau ensure that the path towards enhanced data portability does not lead to consumer exploitation or an uneven playing field between deposit holding institutions and potentially underregulated fintech companies? I've got concerns about that too as you move forward.
Yes, no, you're outlining precisely the challenge here. Again, the consumer is front and center in Section 1033, but there also needs to be information to that consumer about what they might be opening up.
Great, thank you. My time's expired, and I yield back.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair for the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
5 quick, easy questions. PACE loans. Congress passed the law in 2018 requiring regulations, including ability to repay. March 2019, you issued a proposed rule. October 2019 and February 2020, I had a chance to ask you about the status. We need to protect consumers. When do we get the regulations?
Congressman, the answer I gave you, I can give you a slightly better answer than I did in February. The data collection that we need to predicate that notice of proposed rulemaking will begin in September, early September. It was a Paperwork Reduction Act requirement that does take significant amount of time. But by early September, that data collection will happen. So we'll have the data this year.
So the work you promised in February will start in September. Next, I'll urge you to be as quick as possible on that.
Understood.
Consumer credit scores. People lose their jobs because of COVID. They have negative, they're unable to pay this or that bill. Does that a fair entry on their credit report and a good predictor of how well they'll be able to pay their bills once the crisis is over? Shouldn't we prevent these negative items during the COVID crisis from being on the credit report?
I know you're asking a critically important question that you and Congress are actually thinking about and looking at now.
You could solve the problem for us, you know. You could simply prohibit. I hope you will look at preventing these negative items from being on the credit report. But one particular area where Congress has acted, the CARES Act said that mortgage forbearance is allowed to homeowners and prohibits negative credit reporting from using that forbearance. But FHFA charges premiums on mortgages to borrowers who have accessed the forbearance, which means that it is being reported and it's disadvantaging the homeowner. What can you do to make sure that the forbearance that the CARES Act indicates should not be on the credit report is not reported in a way that causes FHFA to raise the premiums?
I can't speak to the premium aspect, Congressman, but I can in the overall context of this. We are working very closely with the NCRAs and with the furnitures to understand, what else they're reporting.
Can you call the folks over at FHFA and say, hey, it's my job to make sure that you don't get this information on the credit report, so where are you getting it?
We will talk about this because you're the first person to mention the premium issue. So I will go back and look at that, and we'll certainly get back to you on what the decision is there.
The next issue is Facebook. The entities you regulate are supposed to make sure they don't discriminate based on age, gender, race, etc. Facebook has this complicated algorithm, so when you buy an ad on Facebook, you don't quite know who you're reaching. Facebook probably isn't going to reveal its algorithms, but if one of the entities being regulated by your agency gets a certification from Facebook saying you have opted for an ad campaign that we are making sure does not discriminate against the people you're not supposed to discriminate against, would that be adequate, or do the entities that you regulate have to not be on Facebook unless Facebook reveals their algorithm?
There are a lot of facts and circumstances behind, obviously, the premise of your question, and I wouldn't want to answer that in this unique case. I would tell you overall that we do engage in fair lending examinations of the institutions. That certainly includes looking at their advertising. And beyond that, I can't get into too much more depth here. But
I hope you would look at the specific. Back in the old days, you'd put an ad in the newspaper, and that'd be their way. Each town had one big newspaper. Now you have so many different choices. When you advertise with Facebook, it's one big entity, but you got thousands of different advertising campaigns you can ask for. And I would assume that you would create a circumstance where if you specify non-discrimination, that it's on Facebook if they violate that. One last thing is these fintech companies that ask you to give them all the information so they can access your bank account, your brokerage statement. Then they can sell the information they know about you. They're providing this free service at the cost of your privacy. What is your perspective? What do we do to protect consumer privacy?
Certainly starting with disclosure, I will say we have some limitations on our oversight of privacy, but I'll say on this point, we do have Section 1033 to look at what the data aggregators are telling consumers in terms of the product, what they're getting from it. And so there are a number of things that we're doing on that front in terms of disclosure and access.
Thank you.
The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Madam Chair. Director, can you detail the resources that CFPB has provided to consumers experiencing financial hardship during the COVID-19 pandemic?
Certainly, we have announced public enforcement. In terms of educational resources, I'll admit my mind went to money, but I'll say for educational resources, extensive. We have issued over 70 blogs and videos, multiple languages, extensive information on how to manage your finances and think about them, what questions to ask your servicers. As soon as the CARES Act was passed, we issued that video and that information within a week, which was a significant accomplishment in moving mountains here to make sure we clearly, concisely told consumers what they were entitled to. And we've had millions of people watch that video in English and in Spanish, and that's something that I think we're particularly proud of in terms of, again, making sure consumers understand their rights. And I commend the financial institutions and others, consumer advocates, members of Congress, that are also sharing that very same information with their constituents and with their customers.
It's important because many of our constituents have never faced the kind of challenges they're facing economically as a result of the pandemic, just as virtually no one alive has had to deal with this kind of a circumstance before. Continuing my line of questioning, you mentioned in your testimony that the Bureau will launch a website with HUD and FHFA for consumers to find accurate information about relief options. Could you outline what consumers should expect when seeking out a forbearance or mortgage relief as provided in the CARES Act?
Yes, Congressman. So we have that website is launched. It's got a lot of the resources I just talked about on it. Consumers can expect that they can contact their servicer and say, I have experienced a hardship, and therefore they are entitled to forbearance if that is either a federally backed loan or a GSE backed loan. So that is clear to them. In addition, even those that are privately funded loans, they have certainly they have direction from all of us as regulators to accommodate their customers, and many of them are also providing different kinds of forbearance, again, consistent with what their contractual obligations and abilities are. But the significant, overwhelming number of institutions are providing options to their customers, and the first step is having those customers contact them. The second is come to us, the CFPB, if they have any issues or questions or complaints, and we are expeditiously addressing those.
I very much appreciate that, Director. As I mentioned earlier, there are many our constituents out there who are facing the kind of economic challenges they've never faced before, and this is a whole new terrifying experience to them. Terrifying. With that, Madam Chair, I yield back the balance of my time.
Thank you. The gentleman from Missouri, Mr. Clay, who is also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes. We will move on. I think there is some technical difficulty. The gentleman from Missouri, Mr. Cleaver, who is also the chair for the Subcommittee on National Security, International Development, and Monetary Policy, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate very much this subject today with Director Kraninger, because I don't know if there are very many other issues that are in the same area of importance. I'm wearing my protective gear because someone close to me has now contracted the virus, and so I'm trying to be as protective of others as I can possibly be. Director Kraninger, I have a couple of questions, and I'll try to make them as clear as I can. I think everybody's already mentioning how things are difficult economically, and so I'm concerned about minority consumers who are frankly hemorrhaging right now and are at heightened risk of attack by financial predators. There's a saying, a sign, blood in the water is a sign that someone can be attacked, especially because they are already in a weakened state. And that's the case right now. Last Friday, July 24th, the CDC released a report, and the first sentence read, and I quote, "Long-standing systemic health and social inequities have put many people from racial and ethnic minority groups at increased risk of getting sick and dying from COVID-19. The report goes on to highlight discrimination as a primary factor in the heightened rate of death of minorities, and especially noted housing and financial discrimination. And so we know that access to emergency relief to help communities of color that are being disparately impacted is not being equitably distributed. A national online survey of 500 African Americans and Latinx-owned small businesses conducted by the Global Strategy Group released a report, and they said after the second round of funding for the program was allocated, they found that just 12% received full assistance they requested, and 2/3 reporting that they had not received any. And so if you go to the Center for Responsible Lending, 90% of businesses owned by people of color were shut out of the Paycheck Protection Program, and of the pending evictions, which economists have termed a tsunami, 40 million Americans may have been evicted. And so I think the first issue is, it would be helpful for me to find out your belief as it relates to systemic racial discrimination. Do you, Director, believe that it exists in this country?
Yes, Congressman, I know that it exists in this country, but it's abhorrent, and it's certainly part of my duty to root that out in the financial system.
Yes, I agree with you, and thank you. Do you think that consumers of color and women have been experiencing this disparate impact during the crisis? Do you think they have been harmed by discrimination?
Well, certainly the evidence that you stated does show that they're not starting in precisely the same place. And we have been doing everything we can to make sure that, and I'll say at the CFPB specifically, supporting our fellow federal agencies in trying to get the word out on economic impact payment entitlements, on forbearance options to limited English proficiency groups, to African American communities, and even on the Paycheck Protection Program. Again, I've had significant outreach as well with communities of color to make sure that they have the information they need and we can increase access to these programs.
Well, a couple of things. I'll try to be brief. My time is running out. But maybe you ought to restore the enforcement and supervisory authority of the Office of Fair Lending and Equal Opportunity. That might be, an accurate or adequate response to the problems we're having. What say you?
I'm sorry, Congressman, I didn't quite catch the last question.
Have you considered restoring the supervisory and enforcement authorities of the office?
I'm sorry, you're asking about the supervisory and enforcement activities we are doing in fair lending? Is that?
Yeah, of the Office of Fair Lending and Equal Opportunity.
Oh, yes. Well, the Supervision Enforcement Fair Lending Division still engages very deeply in supervisory enforcement matters across the board, including fair lending, and we can get you some more information on that.
I think my time is up. Thank you.
The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Well, thank you very much, Madam Chair, for calling this meeting and inviting Ms. Kraninger to be with us. You, ranking member as well. You know, for a number of years now, I've tried to get CFPB to issue advisory opinions. And I want to thank you very much, Director Manager, for actually finally making that happen. It's a great asset that people have to comply with the rules and regulations of the agency to know specifically what they're asked to deal with. We have eliminated so many problems with clients when you did that. As we meet here today, I believe our emphasis should be on the recovery of the economic woes that the virus has placed on us, and on hardworking Americans and their families. And regulation should not become a force that burdens society in the recovery before this vicious virus brought so much suffering both in the nation's economy and to families across this nation. President Trump's policies of reduced taxes and regulations, we're finally bringing our economy back from a long stagnation, sluggishness that we suffered. That followed the Great Recession. Getting government off the backs of our hardworking people gave us the strongest economy in our history. There are important lessons to learn as we go forward. And my first question for Ms. Kraninger is what your early experience was with the advisory opinion pilot program.
I'm sorry, Congressman, you broke up a little bit on the question. So the experience with what specifically?
The advisory opinion pilot program that you implemented.
So with the advisory opinion program as we've launched, what has come in, I'm guessing you'd like to know?
Yes, ma'am.
Okay. So thank you, sir. As you know, we're engaged right now in the pilot, and we're in a Paperwork Reduction Act process to get comments on the full program. We have not gotten anything in yet specifically, but it's only been, a few weeks since we launched that. We do anticipate it, and as I told you, the biggest part about this is it's making formal and transparent interpretive rules that we've essentially been giving to individuals as they've asked along the way. So incredibly useful.
Thank you. Many of us believe that the rules of regulation must be applied with person to prevent over-regulation and restricting credit in such a way that we put a drag on our economy and growth. Of course, the burden on families that need to borrow. Please tell us about your strategy to carry out the CFPB mission without unduly constraining our economic recovery from this pandemic as we go forward.
I'm sorry, Congressman, your sound is just cutting in and out, so it's hard to actually gather the question.
I don't know why. Maybe the lowest bit here is not the best bit of communications.
Well, that I heard, of course.
What metrics and policy instruments give you attention to ensure that we protect consumers but don't harm the recovery?
I'm sorry, sir.
We're having a bit of technical difficulties, and I can't hear Mr. Posey either. So we're going to come back to him. We're going to move on now. We'll be back so that he can finish the remainder of his time. With that, we'll start the clock over. Mr. Clay from Missouri, who is also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes.
Thank you, Madam Chair, and let me thank Director Kraninger for her testimony today. And Director Kraninger, the CARES Act includes important foreclosure and forbearance protections for homeowners struggling to pay their mortgages. Given these protections, it is very concerning that 55% of COVID-19 related mortgage complaints identified struggling to pay the mortgage as the primary issue, according to the most recent Bureau Bulletin. Consumers reported that some mortgage servicers are providing information that conflicts with guidance regarding lump sum payments. What are you doing to ensure that mortgage servicers are complying with the CARES Act?
And thank you, Congressman. That's obviously a significant issue right now. The complaints that you're referencing came in very significantly, particularly in March and early April. So we actually looked carefully at those, and we took a bunch of actions with FHFA and with HUD, including producing scripts for servicers to make sure they are clearly conveying their CARES Act rights to the consumers who contact them. In addition, we are, with respect to the complaints, we noted that a lot of them came around what happened after the forbearance period. So we worked together, and actually the CFPB issued an interim final rule enabling servicers to offer consumers a beneficial outcome, which is a lump sum payment at the end of the mortgage term, rather than having a question over what loss mitigation options would be there. And under the mortgage servicing rules, the fact of the matter is that servicers would have to literally start a full application process that was probably going to confuse consumers. So we gave them this option and acted very quickly with that in partnership with the other federal regulators. I can say we're working very closely on an ongoing basis to monitor those complaints, to monitor what the servicers are concerned about or hearing, what consumer advocates are saying in terms of concerns they're hearing, and housing counselors. And I will say it seems as though those primary early issues have been addressed. We'll keep monitoring as things dynamically change.
And so last month, the Bureau released a proposed rule that would dramatically change the definition of qualified mortgage and weaken consumer protection by replacing the debt-to-income threshold with a standard based on a loan's pricing. Many consumer and industry groups have expressed concerns with such a QM definition that only relies on the pricing of the loan and the broad Dodd-Frank statutory product restriction. A definition that relies on pricing reflects investors' assessment of risk, but does not assess an individual borrower's ability to repay. Can you address that?
Gladly, Congressman. That's a critically important, I think, misunderstanding. The Dodd-Frank statutory requirements remain in effect. That includes consideration and verification of debt and income and that ability to repay. That is still very much a critical part of the process. The question is, in addition to that, how would you determine what is a qualified mortgage and what is assumed to have that? And as we looked at the hard 43% debt-to-income ratio requirement, there are many actually consumer organizations and financial institutions that have supported our approach. That's a pricing approach. It takes into account wider aspects about the applicant and their credit worthiness, but it is not a replacement of consideration and verification of debt and income. That's in the statute, and that continues.
I guess as a final question, have you been able to prevent foreclosures of any great number, or have you been able to err on the side of the homeowner to keep people in their homes? Is there any anecdotal or documentary evidence to that?
Congressman, I certainly believe that Congress took the right action, and I supported HUD and FHFA actually prior to the CARES Act when they put in place a foreclosure and eviction moratorium on the properties that they back. Critically important during that uncertain time, and I know it's something that you're all looking at again now.
Well, thank you so much, and Madam Chair, I yield back.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Madam Chair. There we go. Thank you for being here today, Ms. Kraninger. Appreciate your testimony. And as you heard in my opening statement, I'm supportive of changing and putting a commission in charge of the of CFPB. I was just curious as to your thoughts whether the commission, if it's structured correctly, would be able to complete the mission of CFPB, and whether you thought it would stop it from being a political football, which we had another example of yet today in our opening statement.
Congressman, I certainly would support things that would take down the political temperature. I think you'll recall that is something that I have talked about since even my nomination, and that's certainly been my intent with the actions I've taken. But I do think there are some inherent issues that are stacked against a single director in this dynamic. In terms of the solutions to put into place, I respectfully defer to Congress and what actions you all decide to take there, and I would look forward to helping the agency transition to the extent that such changes are enacted.
I think in response to Mrs. Wagner's comments and concerns with regards to data and screen scraping and things like that, you articulated some concerns, indicated you're watching and looking at it and trying to do some things. Could you articulate a few ideas that you've got with regards to how we can do certain things? I was a part of a group today that discussed this very issue of privacy. How do you protect? Where do you draw the line? Who owns the data? How much access should you allow? I mean, can you give us some just of your thoughts of directions you might be going on some of that stuff?
Yes. Well, certainly we've been talking extensively to all of the stakeholders who care about this, including the industry that are running the technical back and forth of the data. Progress has been made, at least, to reduce screen scraping as the primary method. There are now APIs that are agreed upon between entities that allows you to actually have a transmission of that data in a more secure way. That doesn't mean the consumer needs to hand over their banking credentials to accomplish that data sharing. But I think in our symposium discussion, we found a lot of questions around, what truly is the consumer's financial data. There are concerns by institutions, likely for competitive reasons, over what data might be proprietary around pricing and otherwise. At the same time, the consumer may very well think that data is their own because it's what they're paying, it's what they're getting, it's the services that they have. So I think there are some legitimate questions around that really do get to why we decided to do the advance notice or proposed rulemaking step as our next step on this topic. As I noted to the Congresswoman, this is going to be a complicated area for rulemaking, and to the ranking member as well. There's a broader conversation happening around data privacy and data security that also complicates it. But we will endeavor to, again, get feedback and think about the smartest way to proceed in this issue.
Okay, very good. I want to talk a little bit about, they brought up the idea today about some of the pandemic problems that we're having with regards to, customers and consumers being able to pay back their debts, and the concerns with regards to reporting on it. One of the concerns I have is with regards to forbearance. To me, I'm concerned that if we don't give the regulators, or the regulators don't give the banks and credit unions and those lenders the ability to give forbearance, I'm concerned that we're going to wind up with an elongated recovery here that's going to be very difficult to get out of, and destroy local economies, destroy businesses, take away jobs, much as it did in 08 and 09 whenever the regulators came in and basically got rid of wholesale actions of getting rid of lots and lots of lines of business. Although your area of oversight is a little bit more narrow, it still is in an area where forbearance would be a big help to some of the consumers. Would you like to comment on that just a little bit?
Congressman, you're very correct in that it is certainly something that many consumers would benefit from and have, frankly, benefited from. The first action that we took with the prudential regulators, it was an FFIEC-issued statement, was about accommodating consumers. I do think that my fellow regulators have sent that clear message. So if you're hearing otherwise, we'd love to get some specifics on that so that we can make sure that that is done, though I recognize it gets to safety and soundness issues potentially that are outside my
appreciate
purview.
your comments, but my concern is, I have been a former regulator. I know that the regulators themselves are hamstrung by the rules and regulations that they have to operate under. Yeah. So when you go in, much as they did in 08 and 09, they said, okay, well, my rules say I have to do this, so therefore I have to classify this loan, which means I classify the loan. Now you have to reserve more against it, have to have more capital, whatever the case may be. And at some point, then you turn around and force the banks to liquidate those loans. We're in a position where if we allow the time that it takes to get these loans back up, because of the uniqueness of this recession that we're in, I think we can get back out of this with minimal damage to a lot of our businesses and therefore our jobs and our local economy. So to me, I've got to build it to fix this problem. I appreciate your comments. Thank you very much. With that, I yield back, Madam Chair.
Gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Madam Chair and Director Kraninger. The Bureau's proposed definition of a qualified mortgage would remove the 43% debt-to-income limit from the QM loan definition and instead use a price-based approach that creates a new limit on the spread between a loan's annual percentage rate, APR, and the average prime offer rate, APOR. Now, as someone who's lived through the financial crisis and saw firsthand how much havoc was wreaked on our economy from shoddy underwriting practices, this, to me, shows an amazing confidence in the ability of the mortgage prices to appropriately price risk. The proposed rule itself identifies several shortcomings, which with relying on pricing. It says, quote, the Bureau anticipates that a price-based approach would incentivize some creditors to price some loans just below the threshold in order to receive QM status. More broadly, a lender's pricing of a mortgage reflects many factors outside of a borrower's individual risk profile, including prepayment speeds, balance sheet capacity, business goals, and as well as broader economic conditions. So I'm very concerned with having a definition that could be so easily manipulated. So Director Kraninger, how will you ensure that this rule does not just incentivize an irresponsible race to the bottom, reminiscent of what we saw in the lead up to the 2008 financial crisis? And if the CFPB acknowledges that the APR can be manipulated by lenders, quote, to meet the mark, unquote, then how can this serve as an effective measure of a borrower's ability to repay?
So, Congressman, the nature of a rulemaking process, of course, is that you put a proposal forward and you acknowledge all sides of the argument. So you're definitely doing that with the quote in there. But I will say, taking one step back, the requirements of the Dodd-Frank Act remain in effect. So the features that were so concerning during the financial crisis that are precluded from being qualified mortgage and precluded from being offered this way, those are still statutorily prohibited features. In addition, the statute still requires debt and income to be considered and verified. So that is part of the proposal as well, and it's a premise of the pricing approach. The pricing approach is then what we get to. The 43% DTI cap, well, we frankly found in 2018 a third of the loans that the GSEs backed had DTIs that were higher than 43%. And many of these loans are performing, and many of these loans are also to those in minority communities. And so, again, thinking holistically about what a pricing approach benefit has, and that is that it really does take away, it provides that opportunity above that DTI threshold that's so hard and is going to affect, when it will go into effect in January without additional action by me, which is why we put the rule out. But we're trying to alter that effect.
Yeah, well, I'm very worried about the word consider. While the CFPB's proposal does eliminate the 43% DTI, it does, as you say, require to consider a borrower's DTI as part of the underwriting process. but it also emphasizes that lenders would be given great latitude in how they considered a borrower's DTI. And I'm concerned that consider is just so loose that, people are going to drive a truck through it, and we're going to see this all over again.
Congressman, if I could, there are standards. I don't want to, I know you probably have other questions, but there are standards proposed in the rule for the debt and income consideration, and we're open to industry and consumer groups coming together and coming up with other standards. So there does have to be a standard, to be clear.
Yeah, well, I think that it's having some clarity on exactly what consider means, I think would help a lot in this. And so that's, let's say I'm close enough out of time that I think I'm just going to yield back the balance of my time. I don't really have time to get the next one out. Thank you, and I yield back.
The gentleman from Michigan, Mr. Huizenga, is recognized for 5 minutes.
Madam Chair, at this point, I would prefer if you could go to the next person and then come back to me if that's okay.
The gentleman from Ohio, Mr. Stivers, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Director, for being here today. I want to thank you for everything you do on behalf of consumers. I'm really sorry to see that the nature of your agency has gotten so partisan. I'm convinced that's driven by the structure of your agency. Recently, the Supreme Court, in a Supreme Court opinion, said that your structure violates the constitutional separation of powers. I'm curious what actions the agency is either taking or planning to take to ensure some certainty and stability, given the recent Supreme Court decision. Certainty and stability in your actions, decisions, and the things you do.
Yeah. Congressman, as I said, I welcomed the decision and the action in this because bringing that stability and certainty is certainly what I was hoping to do. And we have looked at prior actions that are ongoing, litigation that's ongoing, prior rulemaking actions, and I did ratify those prior actions, again, just in an abundance of caution to make sure that those could continue to be relied on because they have been relied on appropriately. And certainly going forward, I don't know that it changes a lot, but we are certainly looking at the opinions still and talking to the Justice Department about anything else that may impact.
Thank you, Director. Second, there's been a lot of talk today about your QM rule, and you also temporarily extend the sunset on the GSE patch that is out there. The Bureau is proposing to extend that patch for 6 months after the publication in the Federal Register of the final rule. Do you believe 6 months is an adequate time for the mortgage market participants to develop, test, and implement new standards, models, and business operations? Is it possible that maybe 12 to 18 months might be a better transition, especially given everything that's going on with COVID-19 and the pandemic?
It is a proposal in terms of the time length, and we asked for comment on it. I think, again, based on experience, that 6 months seems appropriate. I will say the pricing threshold is not new. It is actually part of the current safe harbor and rebuttable presumption of the qualified mortgage, so it's not a new concept, and institutions are already doing those calculations. DTI, they're still considering debt and income as required under statute, so it's not precisely a DTI ratio necessarily.
Because of the change. I mean, it is a change. You take the DTI safe harbor at a percentage, take it away, it's still considered. You look at costs more than you are in today's, and it's a little more, it is a change. And so I want to ask you to think about how long that transition will take for folks, that's all.
No, absolutely.
The next issue I wanted to bring up is online security. With the pandemic, more people are doing everything online. And according to the FBI, in 2019, victims lost over $221 million to real estate scams and fraud, and that's based only on crimes that were reported. I've had individual constituents who had mortgage closings where the entire proceeds of the closing have been wired to different accounts through fake emails and scams. And I'm curious what the agency is doing to build awareness on this massive, consumer problem, and what you're doing to help potentially address real estate fraud, scams, and prevent them in the future.
Yeah, the particular scheme that you mentioned is one that we were aware of. I don't recall precisely when. It's been at least a year and a half, I feel like. So that is something that we right away worked with industry on. Yeah. We actually, I believe, produced a video on that, frankly, that realtors were sending out to their customers close to closing to make sure they're aware of that, make sure they know precisely how they should be contacted and where they should be sending closing money. So that is a significant issue. It highlights the need in general to make folks aware of the frauds that are out there, and certainly to use our enforcement actions to go after fraudsters. I'll say a lot of these things, like those online frauds, they're particularly hard because they're generally—
They use offshore accounts, they do lots of other things. So this happened to my constituent about 18 months ago, and it's something I've become aware of and trying to build awareness of. I'd ask you to continue to build awareness. You know, we're talking about $250 million of reported real estate scams and fraud in 19, so probably it's higher today. And given that more things are moving online, I hope you'll continue to look after those consumers, because they need protection, and we're talking about, in many cases, somebody's biggest asset and the entire proceeds scammed from them.
You're absolutely right. And I will say the Department of Justice, the Federal Trade Commission, all of us are pretty engaged in this.
Thank you. I yield back.
Thank you. The gentleman from Connecticut, Mr. Himes, is now recognized for 5 minutes.
Thank you, Madam Chairwoman and Director Kraninger. Thanks very much for being with us today. I'd like to follow up on the question that Ms. Velasquez was talking to you about, which is the revised payday lending rule. You commented to her that it was your opinion that the rule promulgated under Director Cordray resulted in a lower availability of credit, and that I think you implied that the new rule would therefore make credit more available. I understand that, and if I can just frame my question, I think you agree with this framing. Financial regulation is hard because it's always a balance, and always availability of credit is on one side of the balance, and the safety of consumers, somehow defined, is on the other side of that balance. So I want you just to elaborate, please, for us. Presumably you did a lot of quantitative work, and we don't have the time to get into all of the quantitative work, but I'm really interested if you could give us a minute or two on the revision to the rule will provide how much more credit out there at the cost of how many more people who may find themselves in difficult financial straits, whether that's defined as personal bankruptcy or finding themselves in a situation where debts spiral. I'm interested in what the quantification was of finding that revised balance point.
Yeah. And I appreciate your framing of the balance point, because I've often found in my public policy life that seems to be the spectrum we talk on. I certainly believe it's my job to protect consumers while increasing availability of credit, and I don't think it's an either or. I think with respect to this, I'd offer a few other things. The rulemaking itself did have a substantial and dramatic impact on small dollar credit availability, as its own terms said. So roughly 70% of branches would be closed, or those locations would be closed by the rules assessment. But there were other factors, too, that affected credit.
I'm sorry, 70% of locations of what?
Of the payday and title loan outlets. And so the distance that people had in terms of availability. But where I want to get to is also banks and credit unions and others who were also, due to other actions, but also influenced by the rule, other guidance issued by regulators that reduced their interest in engagement in this area. And so I think it's not an either or. A couple things that we're trying to do. One is disclosure testing to look at, for those individuals who may be more vulnerable, is that something that will help? There are clearly consumers who understand the product well. There are consumers who pay within the term. The data that we produced in the rule demonstrated that. There's a substantial portion. Then there's a substantial portion who also defaulted on the loan very early in the term, very early in the process. That also demonstrates understanding of the product. So how do we support and help that last group?
I do want to get an answer to my question. You partly answered it. You said that your work indicated that 70% of payday loan locations would be closed under the old rule. Thank you. That's a very specific, checkable fact. But before you go on to the other stuff you're doing, tell me what the CFPB's analysis showed in terms of the increase associated with bad outcomes, however defined, under the new rule? Or is it your belief that there actually won't be an increase in irresponsible borrowing or negative effects as a result of the newly promulgated rule?
So I would say the way that was, it was the total lending under payday loans that was in that original rulemaking. And I think that's where you start to get to a challenge, because parsing out what was lost, you don't understand what choice that individual consumer was making. What outcome did they get that might have made it worth it to them in terms of that loan? What was the alternative they had at the time? And so that's something that again, additional research could probably bear out, but there is data in the rule that gets to the point that you're making. I just don't have it at my fingertips here.
Well, I really would. I've got one last question. I really would like to understand. I mean, I really do believe there's a balance here, and I really would like to hear from you as to kind of what the implications are. If this form of credit is more available, how many more people get themselves in trouble with it? But in my very short remaining time, I'm having a hard time. This gets pretty technical, but basically the revised rule eliminates the necessity for a payday lender or other lender to come to a conclusion that there's a reasonable ability to pay on the part of the borrower. And I mean, just for the people watching at home, why does that make any sense at all? Why shouldn't a lender undertake a very basic process to determine that there is a reasonable ability to repay?
Madam Chairwoman, I know time is out, so I can
the
say
gentleman's time has expired. Could you please respond to the gentleman in writing?
Yes, certainly.
Thank you, Mr. Himes. She'll respond to you in writing.
Thank you.
The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and welcome back to the committee, Director Kraninger. Thanks also for your work to give consumers access to fair, transparent, and competitive markets by focusing your work on clarifying the rules of the road. I do think giving consumers access to competitive markets and clear rules of the road is, by definition, consumer protection. And because of that good work, I certainly hope this is not your last time in front of this committee. Last July, in my capacity as the ranking member of the Oversight and Investigation Subcommittee, I wrote to the Inspector General of the Federal Reserve asking for details about how the Fed reviews the Bureau's budget requests prior to approval. This week, the Fed IG published its report. This is it. This is the report. I think you've probably seen it. In response to my letter, the report and the ensuing briefing with my staff confirm what I initially suspected, and that is that it's more or less a rubber stamp. The Fed only reviews whether the request is within the statutorily mandated cap. If the request is under the cap, the Fed approves the request. There is no back and forth between the Bureau and the Fed. There is no discussion of any line item. It's just a version of a blank check. And given the fact that Dodd-Frank gave the Bureau extraordinary powers, rulemaking, enforcement, adjudicatory powers, including the authority to conduct investigations, issue subpoenas, civil investigative demands, initiate administrative adjudications, prosecute civil actions in federal court, and issue binding decisions in administrative proceedings, and given the fact that the Bureau can seek restitution, disgorgement, injunctive relief, and significant civil penalties for violations of 19 federal statutes under its purview, it is troubling that the Bureau's budget and funding process lacks any meaningful external oversight. So, of course, the Supreme Court, as many of my colleagues have noted here today, recently held that the Dodd-Frank law violated the separation of powers, concluding that the Bureau's structure limiting the President's power to remove the Bureau's single director is unconstitutional. In my view, this decision properly vindicates the President's power under Article 2 to supervise and, if necessary, remove those who exercise the President's authority on his behalf. The court's decision holds that the Bureau must be accountable to the President, but I would argue that the Bureau should also be accountable to Congress. And the Supreme Court recognized this in its opinion, noting that the lack of accountability is alarming. And the majority opinion said this, and I'm quoting, "The CFPB's receipt of funds outside the appropriations process further aggravates the agency's threat to presidential control." So there's clearly a lack of accountability at the Fed. And as you know, I've been a frequent and vocal critic of this lack of transparency and accountability in the Bureau's spending. I have a bill, the TABS Act, the Taking Account of Bureaucrats Spending Act, which would place the Bureau under the congressional appropriations process. Unfortunately, my colleagues in the majority refused to consider this common sense measure. But I want to ask you, Director Kraninger, do you believe that subjecting the Bureau to the congressional appropriations process would enhance accountability and fix this lack of external check? And would it in any way diminish your ability or the Bureau's ability to protect consumers?
Congressman, I certainly appreciate where you're coming from and asking on this. I definitely respectfully defer to Congress on determining how best to operate this. I do take seriously, of course, the internal controls that I put in place in our budget process and believe I'm accountable for the funds. But
and the IG recognized that good work, by the way. The IG recognizes that good work, and that's encouraging. I just think that we shouldn't leave it just to the agency and your leadership. We, as representatives of the American people, we owe it to the taxpayers, I think, to also hold the Bureau accountable as well. Let me ask one final question also about the QM rule and the change to the loan definition, QM loan definition. Can you detail what impacts the rule might have on the portfolio lending market and how might the changes proposed would help struggling borrowers during especially this time?
Well, certainly providing that certainty with respect to the patch replacement is part of what we think will be helpful hopefully coming out of the pandemic. In addition, in terms of helping struggling borrowers, we did take into account and asked about how this time period should be treated in terms of that consideration and verification of debt and income for borrowers who may have experienced a hardship. So that's also something that will be part of the ultimate rule. So to address that issue that you raised.
Thanks for your testimony and your work, and I yield back.
Thank you. The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Madam Chair, and thank you for holding this hearing. I appreciate it very much. I also want to thank the Director for being here. Thank you very much, Director. You did say earlier that it'd be nice to take the political temperature down a bit. I don't know if you witnessed when Director Cordray was here, the yelling and screaming that would normally come from this side, including some of my good friends, that now find it to be political. It sounds like the old Captain Renault in Casablanca. Gambling, I'm shocked. The truth of the matter is that in cases like this, we do have different views. And I think that plays out. I thank God that we have some people who have real tenacity, like our chair, who made sure that Dodd-Frank was in place. I mean, one of the things that would be disastrous right now is if the banks were failing. If we had all of what we have right now because of the pandemic, and if our banks were crumbling and failing at the same time, we would be falling into a deep depression. So I thank God that we put these regulations in. I wasn't here at the time, but I'm very thankful. And of course, oftentimes that comes because of the rub of politics. I wasn't going to state that, but I think I had to because some of the comments that were made earlier about politics. But I did foreshadow what I was going to ask you about, and that is the issue of these networks and how to prevent fraud and capture fraud. So as you know, the agencies have shown an alarming increase in the financial crime and exploitation during this pandemic. FinCEN has issued 2 advisories since late May on the medical scams, imposter scams, and money mule schemes targeted at consumers. The FBI has also recently stated in a hearing before the Senate Judiciary Committee that the pandemic has only served to increase the number of stimulus, healthcare, bank, elder, and government fraud schemes. The CFPB has ordered a solution to reduce the victimization of elderly individuals. I'm sure you'd agree this solution could also be used to prevent victimization of low-income minority groups that tend to be vulnerable to these schemes as well. Could you comment on that? Because I do think that these networks could be something that could become very helpful.
Well, with respect to the elder fraud prevention and response networks, really fantastic groundswell at the ground level between financial institutions, social service providers, law enforcement, sharing information about what they're seeing. And absolutely, I take your point. I would say one of the things that we find, though, with respect to older Americans is the isolation that is further compounded by the pandemic, which is why putting out additional resources at this time on how to build and sustain those networks has been a particularly valuable undertaking. But there are a lot of different fraud schemes, certainly, that we're keeping an eye on, but that is one population in particular that is further isolated by the pandemic.
So I agree, it's a very vulnerable population. You also spoke, though, earlier about having information in Spanish, too. Obviously, language can be a real issue, too, in these fraud schemes. In your opinion, have these networks been worthwhile? I mean, I know the coordination and everything costs money to do this, but have they been effective?
Yes, we actually have done a couple of reports around that, and certainly encouraging financial institutions to continue to do the suspicious activity reporting to FinCEN, to their partners, making sure partners have access to that information that's happening too. And so we're really rapidly increasing or I guess shortening the time, I should say, for people to be aware of the different schemes and then able to intervene.
And lastly, I guess I would ask about forbearance. I know a couple of my colleagues and friends have asked about this already. Under the CARES Act, forbearance is not supposed to be held against you. In fact, I know that now over at the FHFA, the director there has stated, and I have language here from his note of 5/19/20, that they're going to attempt to not have this be a negative if you're going to refi or buy another house if you're in forbearance because of the great interest rates at the moment. But again, I would ask you to take a look at that because this is an extraordinary moment in our history, and a lot of people that could normally pay their mortgage are in trouble because of the pandemic, and hopefully we can get over this and get back to a normal. But anyway, I would ask you, as my colleagues did, to follow up on that. And again, I thank you for being here. Thank you, Madam Chair. I yield back.
The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate that, and it is good to have you here today, Director, and I appreciate your time. I would remind my colleague and friend, and he is a friend from California, that there's a number of us that have been amazingly consistent in our belief that the structure of the CFPB needs to be a commission. And whether it was the Duffy legislation in previous Congresses or the TABS Act, as my colleague Mr. Barr was talking about, I do believe that this is the right way to have an organization like the FPB. Director, I guess I'll ask a question along the lines of what my colleague Mr. Barr was asking, but I'll maybe refine it. I understand you don't want to get into the what should Congress do question, but let me ask this. Do you believe that somehow the ability to protect consumers would be diminished under a structure or a commission structure, I should say? And would consumer protections be lessened under a commission approach?
Congressman, I'll certainly say there are other organizations that have commissions, and that's something that I'm sure could be looked at or compared. I will say at this point, it's a similar answer to you. I know not fully satisfying that I will allow you all to make that call yourselves and certainly take any action that Congress directs us to take by law.
Well, and I fully understand that. I guess that's one of our jobs is to ask those types of questions to find out whether those involved and engaged believe that there would be a diminished ability for them to do their jobs. And that's the nature of my question is really more along those lines, trying to make sure that based on your professional experience and your opinion, whether you could effectively do your job with a different structure. Let's say Congress decided to move away from the dictatorial structure that they currently have and decided to make it every single decision you made would be subject to a vote of Congress. I don't think that would be a wise move. I would assume professionally you would maybe discourage that. I'm reminded of in the previous administration, the director Cordray had no problem sharing his opinion with the idea of whether there should be a commission structure or not. So I'll give you one last shot at that if you care to expand. Do you think that you could make that type of structure work?
Congressman, how about I tackle it this way? Certainly, if I see legislation that I think would be detrimental to the agency in terms of on this and it's progressing, I will certainly let you know my views. And I welcome the action on structure by Congress, generally speaking, and I do believe that Congress would come to a good conclusion on that.
Great. Okay, that is helpful. And unlike the chair, I guess I hope this isn't your last appearance before this committee. Let's move on to credit reporting and debt collection here. And sorry, I don't see the clock right in front of me, so I'll try to move quickly. We know, and I think so, there was action in the CARES Act about protecting credit debt collection. Getting a lot of background noise. But we know that may be a temporary fit. But what long term with could that adversely affect consumers?
Congressman, I think you're asking about the credit reporting, but you did cut in and out. So if there was a specific question, I know we don't have a lot of time left.
Yeah. Okay. Well, so what type of negative effect might there be on credit for consumers if there is not accurate credit reporting that is allowed at all? I believe that there's a proper time and is a proper time under the CARES Act to suspend that. But if this becomes a long-term solution, which I know some of my friends on the other side believe ought to happen, that there should never be any sort of actual accurate credit report. And I'm curious if the negative effects.
Yeah, accuracy in the system is hugely important. I would at least agree with that, and I know where
the gentleman's time has expired. The gentleman from Florida, Mr. Lawson, is recognized for 5 minutes. Mr. Lawson.
Can you hear me? Can you hear me?
Yes, we can hear you, Mr. Lawson. Yes.
Okay, thank you very much, Madam Chair. And to you, Madam Chair, and Ranking Member McHenry, appreciate y'all having the hearing. My question centers around, because I have so many students in my area. As you know, the CARE Act provided student loan relief that includes suspending payment, interest, and collection on governmental health federal student loans from, I think, March the 13th through September the 30th, 2020. I'm especially concerned about how Credit Reporting Bureau and the lenders that furnish data are not complying with the federal coronavirus relief requirements under the CARES Act. Some student loan service appear to be reporting the student loan and delinquents
in non-payment status to National Credit Bureau. On May the 20th, students loan borrowers filed a class action lawsuit against Great Lakes and the major credit bureaus for their erroneous credit reporting. Director, what are you doing to ensure that Credit Reporting Bureau and the lenders that furnish data are complying with the CARES Act and holding accountable to the companies that do not?
Congressman, thank you. It's an important issue with respect to credit reporting agencies and the furnishers that, of course, provide the data to the credit reporting agencies. And so we are actively engaged in ongoing oversight over FCRA compliance with respect to accuracy and dispute resolution. And the CARES Act requirement is certainly an overlay of that. One thing we're doing under the pandemic is a prioritized assessment, which is a kind of special exam going in and looking at what is happening right now. So we are going into furnishers, looking at their compliance overall. That includes in all product areas. We did an assessment of risk. We recognize that the student lending space, given CARES Act requirements, was an area that should be looked at. And so we are going in and looking at the furnishing side. We are also talking to the CRAs about how they are engaging on their side as well to make sure that there is compliance happening. With respect to, I think, Great Lakes, there were some mistakes that were made that were caught very quickly, both through complaints to the Bureau and things that consumer advocates and financial institutions noticed. And there was a very quick resolution, both in how scoring happened and the data that was provided by the furnishers. So that was something that was addressed very quickly, and I think it's a good example of how quickly we can act when we see mistakes are made.
Well, that's great. What's the status of that lawsuit at this point, or is it too early to make any comments on it?
I'm sorry, Congressman, was there a question there? Or?
Yeah, I was just saying, I was trying to see if she could elaborate on the status of the lawsuit at this time, or is it too early to comment on it?
Oh, understood. The Bureau is not a party to that lawsuit, so I'm aware of it, but I do not know the status of it.
Okay. With that, Madam Chair, I yield back.
Thank you very much. The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Madam Chair and Director Kraninger. Thanks for being here, and hope you have an opportunity to do it 8 more times, if you'd so choose. We recently had, and this is a little follow-up to Mr. Huizinga's questions, Secretary Mnuchin was before the committee a few weeks ago, and he'd noted that credit reporting agencies, in order to be able to function properly, need to be able to maintain a complete profile of the consumer's credit history, especially during this pandemic. Some proposed legislation that we have would suspend negative consumer credit reports during the COVID-19 pandemic and any other future disaster for a period of 120 days or until the emergency ends. My view is this would weaken, not increase access to credit, as lenders would lose confidence in the accuracy of the information before them. And I guess my question is, do you agree with Secretary Mnuchin that it's important to be able to maintain complete credit profiles and not alter credit-related data during this pandemic?
Well, let me answer it this way, Congressman. The Fair Credit Reporting Act actually holds accuracy in the system as a high priority, and the Bureau is tasked with compliance with those FCRA requirements around accuracy in the system. It is hugely important. I appreciate why you're raising the question, because there is a concern with respect to the system itself. If those lenders who are seeking to do a creditworthiness assessment can't actually access information or trust the system to give them good information, then there's a problem. But we also have the situation where we're looking for alternate data and other sources of information that is going to give a more robust credit picture of a creditworthy borrower. And so there are a lot of discussions around what happens in the credit reporting system. I clearly recognize that as well, and certainly within, with respect to making sure that those minority communities as well, that individuals actually have information in the credit reporting system that will enable them to get credit if they're credit worthy.
Great, thank you. As we previously discussed, responsible debt collection is an important part of maintaining access to credit for consumers, and ensuring good access to credit is more important now than ever, especially in rural places like the ones I represent. But the technology has changed dramatically since the last time the debt collection rules were updated, and CFPB has proposed common sense reforms allowing mandatory disclosures in the body of an email to be able to ensure consumers have access to important information in a timely manner. But communication is a two-way street, and both collectors and consumers should be able to communicate with one another electronically, especially during this pandemic. My question is, would the Bureau consider allowing an exemption from the e-Sign Act requirements for validation notices for companies who are otherwise complying with the FDCPA requirements and rules?
Congressman, we have recognized some of the challenges with e-Sign Act requirements pursuant to the pandemic and did provide some flexibility. I'm not aware of a concern or conflict with FDCPA or other challenges with respect to that. But I can tell you that our debt collection notice of proposed rulemaking does address electronic communications, in addition to obviously continuing to preclude harassing communication. Trying to facilitate that two-way communication that you talked about is important, setting some bright line rules for it and enabling individuals to communicate the way they want to communicate, whether that is receiving texts or receiving emails rather than getting phone calls, for example. So those things are all addressed in the rule, and we're pouring through comments right now to think through the right approach going forward.
Okay. Thank you. And Mr. Stivers brought up some issues in regards to technology and fraud, but could you maybe expand a little bit on the financial technology and how it's changed during the pandemic and how you're monitoring the regulatory environment around the technology to be able to make sure that consumers can safely access the important tools?
That is critically important. Clearly, we have a number of processes that contemplated in-person interactions or expect that, and we've done a lot to address it in terms of appraisal processes and other processes in terms of particularly mortgage loans and mortgage origination. So it is something that we're looking at. The Bureau also is engaged in technology sprints to think about, again, how do we promote electronic disclosure. But the point that you raise is a real one, and that Congressman Stivers did. You have to take into account fraud and other cybersecurity issues, privacy issues with that data.
Thank you. I yield back.
Thank you. The gentleman from Texas, Mr. Gonzalez, is recognized for 5 minutes.
Thank you. And thank you for being here before us. Our nation has a patchwork of mortgage protections in place, and this fact is reflected on the Consumer Protection Bureau website, which highlights that we have one system in place for at least the federally backed mortgages. And up until now, we've relied on the tendency of non-federally backed loans to simply follow along the path. While many lenders have voluntarily given similar relief as the federally backed programs, consumers are not protected in this lending space for COVID-induced foreclosures and financial problems. First, how is the Consumer Financial Protection Bureau helping consumers with non-federally backed mortgages, and do you have the tools and authority that you need to help these folks?
Thank you, Congressman. There are obviously distinctions there with respect to CARES Act treatment. One thing that we did very early on in the pandemic was clear direction to all entities subject to our responsibility, our regulated entities. Their first responsibility is accommodation of customers during this time, consistent with safety and soundness and compliance with consumer protection law. So that does send the strong signal to all those that are regulated, including those entities that are servicing non-federally backed loans, about those requirements. And I would say, generally speaking, the information that we have is that the right steps are being taken there. But we also have the backstop of our supervision and enforcement activities to ensure that that is the case and that they are complying with the law.
Okay. Changing the subject just for a second to landlords, what can a landlord do who's not getting their rent but has eviction problems and foreclosures looming? How are they getting help, especially smaller landlords?
I will say, Congressman, the landlord-tenant issues are a little bit outside of our purview. We have we took on the responsibility, recognizing the need for one federal government website to provide that avenue for landlords, tenants, borrowers, everyone to get information from one site. So we do have cfpb.gov/housing, but it's really HUD and a few other dynamics there in the states that have the avenues for and resources for folks to follow. But we're trying to make at least a conduit is one place to go for that information. So we are housing that information.
Yeah, that's a concern, just particularly smaller landlords. Do you feel like the Home Mortgage Disclosure Act, which requires many financial institutions to maintain, report, and publicly disclose loan level information about mortgages, is useful in detecting discrimination in the marketplace?
No, that is one of the purposes of the Home Mortgage Disclosure Act. Certainly the collection of that information does provide transparency to the marketplace and to the public, and is useful to agencies. We do use that information on a regular basis to engage in fair lending analysis and to understand what's happening in the marketplace.
Are there improvements that you believe could be made?
We are continuing to improve the way that we make that data available. I have also looked to work with our partner agencies around how we do the fair lending analysis. Each agency does it slightly differently, and frankly, I'd like to better understand that. So we've been trying to get the economists together from each of the agencies to see how they're doing that analysis, frankly, to help also institutions, because many of them do the analysis themselves to also ensure compliance with the law. So I think there's a real opportunity to look at how we analyze that data, thinking about it, sharing it, understanding what it means, and understanding what we're looking for. So that's a dialogue that I have sought to further.
Thank you, and we look forward to working with you on that. And I yield back.
Thank you. The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Madam Chairman, and thank you, Chairman, for being here today. And before I begin my questions, I just want to echo what we've heard quite a bit today about the Supreme Court and their decision that said the current structure of the CFPB is unconstitutional. And I think you've been 100% improvement over the first director. I still think it would benefit everyone if there was greater oversight and less power concentrated in one individual. Now, Director, the economic recovery from the coronavirus is going to be driven by small businesses, Main Street America, opening the doors and hiring back workers. These businesses are going to need to adjust their storefronts and business models to make the necessary changes to make this happen and to satisfy state and federal safety guidelines. The ability for a business to access capital will be critical during this time. So the CFPB is under a settlement agreement to adhere to a predetermined timeline to issue a rule regarding small business data collection in accordance to Dodd-Frank Section 1071. As I've mentioned to you before, you and I have talked about this, I have serious concerns with the effect that this rule will have on the cost of capital to all businesses. So could you please give us an update timeline on the implementation of this rule and tell us how you will ensure that these actions will not inhibit small businesses and Main Street from getting loans?
Yes, Congressman, I absolutely understand your concerns and frankly share some of them as well. I will say that Section 1071, of course, is a mandatory rulemaking in the Dodd-Frank Act. Even in my confirmation process, I pledged to make that a priority because it is a required rulemaking. So we are engaged in that effort. We are issuing a SBREFA outline by September 15th. So that is the small business regulatory relief process where we sit down with a panel of affected small businesses with the SBA, with OMB, and go through that outline and get comments. So it is a kind of early stage in rulemaking process. So we will have a draft proposal out by September 15th, and this fall we'll engage in that process of discussion of that draft. And then the next step after that would be a notice of proposed rulemaking, but we have not come up with any firm timeline for that.
Thank you. On June 18th, the Bureau announced a pilot advisory opinion program that would allow businesses to try out new products and services without fearing that CFPB would come down with some enforcement actions for trying something new. This is a welcome step towards providing more certainty to the private sector that is often fearful that they will be targeted by your agency. So, Director, how have you been publicizing this pilot program to industry participants, and can you give us an update on how many people have submitted requests to be a part of this program?
Congressman, I'm sorry, which pilot program?
It's called the Pilot Advisory Opinion Program.
Oh, the advisory, absolutely. I wanted to make sure I had the right pilot program. That's okay. So the advisory opinion program is out for comment right now, so it will go final. When we collect data from an entity, we need to actually do the Paperwork Reduction Act. So needless to say, we launched the pilot, but we expect to be fully going soon. It's an interpretive rule that we would be issuing. We have not gotten any applications yet, but any entity that is seeking an interpretation or additional information about how to comply because they have a particularly challenging issue. What happened prior to this program is they would send us an email through our site, and we would send them back some answer. Right now, though, I think that process should be transparent. I think all of the entities that are equally situated should actually benefit from getting that information, and it should happen formally from the agency and not just informally through trade groups or otherwise when someone actually gets that useful piece of paper. Sure. So that's what we're hoping for with the advisory opinion program.
Thank you. I'm in the credit business, and when this whole pandemic began, I said I did not want to see a person's credit score like we saw in 2008, ruined as a result of the pandemic and the mandated government shutdown. So, as you know, the CARES Act, and we talked about this, included provisions for lenders to work with their customers who make changes to their credit accommodations, such as adjusting or delaying certain payment agreements, while at the same time ensuring the integrity of the credit reporting system is kept intact, which is very important. Last week, TransUnion released a report that shows delinquencies decreased in June on a month-to-month basis, which makes it seem that people are still managing their finances and debt with responsibility throughout this pandemic, and that the CARES Act provisions have been working. So quickly, Director, does this data point released by TransUnion align with what your Bureau is seeing?
Yes, it does.
Good. Thank you. I yield my time back.
Thank you. The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you, Chairwoman. Thank you, Director, for being here. I appreciate your time. I'm actually in the people's business. That's what I do, is help people. And I know during this pandemic, your Bureau received a record number of complaints, I think 42,000, a little bit over 42,000 in April, and a little over 44,000 complaints in May. And so I want to talk to you a little bit about this. I know it's about a 60% increase, Director. So I just want to know if my resident is calling, and of course, they qualify for forbearance, they're calling over to their mortgage company, then they call you all. What is the process that they go through to get your help and your advocacy to make sure that this mortgage servicer is complying?
So that complaint is processed immediately, sent to the relevant company. We do a little bit of quality control on that in terms of making sure it's something that can be responded to, but that is sent to the company. And I did get a little bit of an update from a prior question about the average response time. So our average response time of the consumer getting an answer from the company is 9 days. So that is what is generally happening in terms of the issue that they're raising.
Do you know, that's great in some cases. Do you know what the resolutions are? I mean, are they just contacting via email, or are they resolving the issue? Because what I'm hearing from residents is they qualify for forbearance, but the mortgage servicer is kind of giving them a runaround.
So it is a response. We do quality control on the responses back. We also, particularly with respect to mortgage servicers and the CARES Act forbearance and the issues that are happening right now, we're looking at all of those. To see if there's an issue with a particular servicer.
So give me an example of one that you all resolved. And it doesn't have to be mortgage. I know the next number one issue folks call about is credit cards and then issues with their consumer report or credit report.
Well, the one that has gotten a lot of attention, it certainly got my attention, was in late March and early April. We did get a significant number of complaints submitted around concern about payment of mortgage payments and around the forbearance option that was given to servicers when they would have to pay, because the initial information from servicers was, we'll put you in 90-day forbearance, you're going to have to pay that full 90-day deferral after the 90 days, because that is the way the process tends to work in normal times. So that concern came through loud and clear, because people said, I can't pay now. I'm sure not going to be able to pay in 90 days. That is something that we took very seriously. I talked to FHFA in particular, but HUD, all of us came together as federal partners and said, that really doesn't make sense. That resulted in some guidance from them, but also an interim final rule adjusting our mortgage servicing rules to make clear that the option that can be offered is deferred to the end of the mortgage period. So that is to the end of the loan, a lump sum payment at the end, and that was I think a demonstration of how this can work and how it should work.
Yeah, and Director, in that case, that service, it was just that mortgage servicer. It wasn't any other companies. They just tried to find it. So we had to actually school them and get the actual accurate guidance that that's not how they had to do it. So what happens to them when they do that? I mean, what do? I mean, smack them on the hand? I mean, what exactly happens?
I think
because my worry is what else are they doing that if they can get away with it, or maybe we don't find out about it. Some people don't even know to call you. Your bureau. Just curious what happens in that case. Do they get fined or something?
Absolutely. If they are not complying with the law, they can have to pay restitution. There are other outcomes. I'll say the example I gave you is a good example of where they were doing what they should do, but it was not the outcome that any of us would want. So I think there are a lot of examples across the board, but making sure we address servicers who are not taking compliant action with the law is important too.
And the last question, I mean, are you all, do you work with other departments? One of the things I've noticed is if there's a huge, I think this might. If do you all ask or see a pattern of complaints maybe from communities of color? And do you work with the Civil Rights Division within the Department of Justice if you see a pattern of discrimination based on someone's, ethnic background, faith, and things like that? But primarily, I'm seeing a huge impact on African American community and people of color. I'm wondering what your bureau is doing to work with other agencies to push back on that.
Definitely, if we see a pattern or practice there, we have our own authorities, obviously, to act under ECOA, but we also do make referrals to DOJ and work with them closely.
Yeah, thank you, Madam Chair.
Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Madam Chair. Appreciate the opportunity to have this hearing. Kraninger, I want to commend you for leading the agency during this very difficult time of COVID-19. Given the current economy, many of us in Arkansas and many of our families have been really navigating a tough consumer financial space. I want to thank you, the agency, for doing a number of good updates and helpful aspects to your website. We've been using these routinely newsletters we send out several times a week on the COVID-19 crisis, and the material has been very beneficial to consumers. So please thank your team for the extra efforts to communicate. I want to touch, Director, on the topic that Dr. Foster spent quite a bit of time on, which is your revisions for the qualified mortgage rule. He walked through, I think, the background quite clearly, and a lot of us are concerned about will this rule approach that you're taking, that you put out for comment, lead us down a road towards weaker credit underwriting by the banks or by the federal entities that insure or purchase those loans. And you did a good job answering his question, so I won't belabor that point, that the DTI is just one of many considerations to be taken in underwriting. But since that's true, what's your philosophy here? I mean, all bankers take into a variety of compensating factors when underwriting a loan. Why do you view that it's necessary to replace the DTI definition with something that appears pretty open-ended?
I think, Congressman, and appreciate your interest in this. It's an important marketplace, clearly, for mortgages for many Americans. The point that you just made is precisely why we're moving from DTI solely to a pricing approach, because it really does bring in the more holistic considerations of the borrower's creditworthiness. And certainly you would expect and want responsible lenders to be pricing in the risk that they see. And that's a different approach than a hard debt-to-income ratio that, frankly, at 43%, but frankly, as we looked at what would be an acceptable DTI threshold if you were going to stay at that. And we, in fact, asked that question in the rulemaking. But clearly at 43%, we know we're keeping a lot of creditworthy borrowers, and particularly borrowers of color, out of the qualified mortgage market.
Thank you for that. Do you have any concern about that granting a safe harbor to underwriting standards, third-party guidelines could be too open-ended? Are you concerned about that?
So it isn't just third-party arbitrarily. It is third-party guidelines that we would have to actually recognize. So there is that check in the process. And I think I'm sorry.
Your agency approve those guidelines?
Yes, that is what is proposed.
Okay.
So it would allow innovation.
Let me switch subjects, talk about the difference between the 150 basis points pricing range that you've considered, and yet for the safe harbor, you think it should be 200 points for the QM. Don't you think that spread could do two things? One, create a potential for misunderstanding and lawsuits, and that it would actually deter private sector players from making the loan, and could that even shift it more to a government type loan such as an FHA loan? Are you concerned about that spread?
Well, certainly it's a proposal, Congressman, so we absolutely want comment on that to the extent that anyone in the public has data that would demonstrate a greater risk. We outlined, why we chose that threshold, and it's not too different from the thresholds that are already recognized in the current QM, because there is a pricing threshold differential between the safe harbor and the rebuttable presumption now. So the APR-APOR spread is something that's in the current system. But again, looking at, we looked closely at performance over the last many years. That data is in the rule, and we welcome comments on, alternate concepts or risks that might be introduced here.
Thank you, Madam Chair. I yield back.
Thank you. The gentlewoman from Iowa, Ms. Acne, is recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Director Kraninger, for being here. I'd love to start with some positive news by thanking you and your staff for taking some time to give us some feedback on a bill I introduced a couple months ago to create a working group with the CFPB and the SEC to help protect consumers and investors from fraud. So thank you for that. I do hope we can move forward to get your two agencies working together to prevent Americans from being taken advantage of. And I also appreciate the website you set up with information on the prepaid debit cards that a lot of Americans received. Wish that had been communicated earlier, and my colleagues and I may not have had to push the Treasury to make those improvements, but thank you for those two pieces. I want to go back to the last time you were here. You had signed an information sharing agreement with the Department of Education on student loan servicers, marking the first time in more than 2 years that information was properly being shared. But 2 years is far too long to go without full compliant information that we need to understand how the $1.6 trillion of student loan debt is being handled. I'm glad that part is resolved, but it should have been done much sooner. However, not only did that agreement not restore the supervisory MOU, The last time you couldn't even tell me when that would be done. In September, just a month from now, we'll be at 3 years without the Consumer Financial Protection Bureau properly supervising student loan servicers for the 40 million Americans with these loans. So I'm going to ask you again, when are regular exams of student loan servicers going to resume?
Congresswoman, I'm happy to be able to tell you that they have already resumed. So we started, and that was the lag time, frankly, between the February House hearing and the March Senate hearing. I managed to get that done in February so that the supervisory exams commenced. And so there are no barriers to us doing the supervision work that we need to do in the student loan space. And we're working very closely with the Department of Education so they can continue to do their contractual oversight, but we are pursuing our own information requests. We are getting that information, and we are engaging in those exams.
Well, perfect. What I've heard, though, that there's been one exam done, and that was in March. Is that correct?
Congresswoman, we do not stipulate what exams are happening in what product areas. I made the exception by at least trying to show Congress, recognizing the great interest in this, that one had happened. But I can tell you the number.
So I appreciate that. But have you done any exams since that March exam?
There are no barriers in our way. We're doing all the exams that we would like to do. That's what I can say at this point in time. And I know that's not satisfactory to you, but we don't talk about the numbers of exams we do in any given industry.
So, okay, well, so I'm going to take that as a no, because if you can't tell me that you've had more than one exam and you won't answer the question, I'm assuming that that's a no. So when will
Congresswoman, that's not a no. I don't want to parse words with you, but it is definitely not a no. We are engaged in every exam that we need to be in the student loan space.
So how many exams have you had?
Again, that's not a publicly disclosed number. It's not in any area except our total number of exams conducted. We don't issue exam numbers publicly in each industry, particularly in areas where they're small.
So what's the total number? So you don't issue it for each industry?
No, we do not, and never have. So again,
that's certainly a problem that we're going to have to figure out, because how are we going to make sure that there's oversight of these 40 million loans that are people in this country need to have oversight of if we can't get that information? And you're not willing to tell me how many you've done within this industry. That was the specific question.
I understand. It is not a publicly available number. It's something that I think is appropriate given the confidential nature of supervision. Same with the number of investigations that we have ongoing in any industry. We don't actually disclose that publicly, given the confidential nature. Certainly when it's public, we do have a number of ways to do that, and I am absolutely looking at this, but I am trying to tell you that it is not any obfuscation. This is important, and we are engaged in every exam that we need to be.
Well, listen, from what I've been told, there's been one examination, and I believe there should be around, there's about 12 servicers, 10 to 12 that would need an examination. So I think we're not, I think we're failing the people in this country right now.
Well, you were told there was one exam because I am the one that actually publicly released that there's been at least one exam.
So we just went all through all that, and now you just said that there's been one exam.
Thank you very much, and we'll explore that a little bit further, Ms. Acme. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Madam Chair. Appreciate the opportunity. Thank you, Director Kraninger, for being here today, for the great work you're doing. Unfortunately, under the Obama administration, Democrats created an agency completely unaccountable to the American people. Outcomes and oversight of the agency were by no means transparent. We've also unfortunately faced unnecessarily partisan attempts to reform the structure of the Bureau by putting it on a budget and creating a bipartisan board. On a brief personal note, Director Kraninger, I want to sincerely applaud you to being open and accessible to every member. My staff and others constantly praise your efforts to be responsive to our requests for input and feedback. I know this willingness to meet and discuss policy occurs across the aisle as well, So I just wanted to take a moment to thank you for your service. I also wanted to thank Paul Watkins and the work you're doing to advance inclusion through fintech innovations. This is one of our top priorities at the committee and at the fintech task force. He didn't receive the most welcoming comments from the majority when he came before us, but advancing fintech innovation to help those in need should be a nonpartisan issue. Now more than ever, families have access to options to cover need to have access to options to cover unexpected costs. For many, short-term lending can be a lifeline in difficult times. Abuse cannot occur, but this must remain an option. Your work to ensure borrowers have access to loans will increase competition and choice in the marketplace at a time when it is so desperately needed. Turning for a moment to ongoing litigation started by the past administration. Director Kraninger, I noticed that in your budget request, there is no mention of the funds the Bureau expends to continually pursue Cordray-era litigation. Can you please speak to the cost of that ongoing litigation?
Certainly, the Bureau continues to engage in litigation both before and under my term, and also litigation that Director Mulvaney approved at the time that he was director. There is a cost, obviously, as you noted, and we do include in the budget lines for expert witnesses and document production and things like that. But I don't think, Congressman, I can give you a specific delineation for which director signed off on which enforcement action and what the litigation costs have been. But certainly there are some complex litigation cases that we are still involved in that are costly, but I've deemed them necessary to continue.
I'd love to follow up with you outside of the hearing on that. Listen, I share the concerns of my colleague French Hill when it comes to, I also share the praise that Mr. Hill was giving you for your work to update the qualified mortgage rules. But I do share his concerns that he raised with you, and I'm not going to go over those again. Appreciate you being aware of them and appreciating the concern. And now that we have a definitive answer that CFPB's leadership structure does violate the separation of powers, I'm curious about your plans regarding transparency and accountability. Given these developments and under your leadership, where do you plan to take the CFPB?
Congressman, certainly since I was named and testified before you all the first time, that has been something that is significantly important to me, given my public service career. So we are endeavoring to engage in that transparent dialogue in every aspect of what we do. I'd say the advisory opinion program that was recently launched is a great example of that. Again, we're providing guidance or essentially interpretations to one entity that asks. But through that advisory opinion process, we're making that public. And we are providing that interpretive rule to everyone so that they can see what the rules of the road actually are. And it's not just benefiting one entity or who that entity decides to share that with. So that is one example. And certainly our rulemaking efforts as well in trying to ensure that we are fully transparent there.
My colleague Andy Barr was asking about congressional oversight of your budget. And I know you didn't want to step in to Congress's role, but could you answer the question? Would congressional oversight of your budget inhibit your ability to do the job as director?
Congressman, I've endeavored not to get into that, but I will certainly acknowledge that I was a longtime appropriations staffer on both sides of the Hill.
I'm sure we'll talk more. Thank you for your time, Director. Madam Chair, I yield back.
Thank you. We have now reached the end of Group 1. The committee will stand in recess for 5 minutes while the room is cleaned.
This took a little longer.
Franklin, can you grab Mr. Rickman's nameplate, please, from the back?
I know. I texted him.
Gonzalez?
Yeah, Gonzalez is going to sit in the chair first.
We're snakes. So after Holmes, we're
Yeah, Rose. Yep.
So then after Rose should be Style, Gooden on this row.
So Styles down there. Grab Style and Gooden. Thank you.
So these are all same day, and you didn't even know that.
Yeah, don't worry about it. We can also move them. Katrina.
You're good.
Gooden.
And
Riggleman's down here.
And then Taylor.
And then Taylor. Thank you, Katrina.
Okay, that's your back. I need to put out the paper.
The committee will come to order. The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
Director Kraninger, would your proposed rule to eliminate the Fair Debt Collection Practices Act prohibit repeated calls from debt collectors?
Congresswoman, harassment is still going to be illegal under that rule. What we're trying to do is set a bright line rule, and we proposed one. So, yes, the hope is to have a bright line rule.
I know it was a little bit hard to hear there at the start, so let me start over. Would your proposed rule to implement the Fair Debt Collection Practices Act prohibit repeated calls from debt collectors?
So, Congresswoman, it's a proposal, and it did in fact propose a limit on the number of calls that could be received in a week. Yes.
Yes, great. Good work. Would it prohibit those debt collectors from making calls harassing families and friends?
Well, yes, harassment's already precluded by the law.
So we can agree that harassing practices by debt collectors are something that you can probably pretty comfortably say falls within the jurisdiction of the Consumer Financial Protection Bureau.
Yes.
Great. In the last 4 years, has the Bureau taken any enforcement actions to punish medical debt collectors that break the law and harass consumers?
So we have taken public enforcement actions against debt collectors. I am not sure about the, what kind of debt off the top of my head.
Okay. I'm specifically asking about medical debt collectors. Have you taken any enforcement actions against medical debt collectors?
I understand.
That break the law?
I understand the question, Congresswoman. I do not have an answer for you at the top of my head. Many of the debt collectors actually collect on behalf of multiple clients, so it is very possible.
Okay, so let me answer that for you. The CFPB has taken zero actions against medical debt collectors. So if you're just tuning into this hearing, here's what you've missed. Nothing. You've missed nothing, because that's what the CFPB has been doing to protect you against predatory medical debt collection, even in the midst of a terrible pandemic. The CFPB, Ms. Kraninger, was created to protect consumers. That's its mission, that and nothing else. Would you consider it pro-consumer to not enforce the law to prevent consumers from being illegally abused by debt collectors?
There were a lot of caveats in that statement, Congresswoman. Let me just tell you that we are committed to enforcing the law. I am committed to enforcing the law, and we have taken action against a number of practices in the debt collection space, including through our supervisory efforts. So it is not just the public enforcement actions that you're citing, certainly supervision. We've issued supervisory highlights that articulate what we have done in the debt collection space. We provide information to consumers about their expectations in debt collection.
But Ms. Kraninger, just to be clear, if I'm a debt collector, if I'm a medical debt collector, I can break the law under your CFPB and know that there is a 0%, if the past predicts the future, and we're looking back at the past 4 years, that there is 0% chance that I will get sued. How is that robustly enforcing the consumer mission of the agency?
Congresswoman, I respectfully disagree with you. There is certainly no guarantee that that is the case, and I would endeavor to have you give us information on any debt collectors that you are concerned about their practices. We absolutely follow up on them. It is a career decision to open an investigation at the CFPB, and I welcome any information that you have on bad practices.
But Ms. Kraninger, in your own database, in the CFPB's own database, there are thousands of complaints about medical debt collectors. Each time you come before this committee, I appreciate that you welcome me to do your job for you, but my job is to make sure you're doing it. I wanted to ask you about something else. Are you familiar with Mike Hodges? Hodges?
No, I do not believe I am.
You aren't?
I don't believe so, no.
He is the CEO of Advance Financial, one of the country's largest payday lenders. Do you know how much he's donated to the Trump campaign?
I have no idea, nor do I care.
So you don't know anything about him. Let me read you this quote. I've gone to RNC Chair Ronna McDaniel and said, Ronna, I need your help on something. She's been able to call over to the White House and say, hey, we have one of our large givers. They need an audience. The White House has been helpful on this particular rule we're working on right now. That was Mike Hodges in October 2019. Do you know what rule he was talking about?
Time.
The gentlelady's time has expired. What did they do? The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
Thank you, Madam Chairwoman. Director Kraninger, thank you and your team for all the work you're doing to protect America's consumers. I appreciate having you on the job. I want to say a special thanks to Paul Watkins and the attention he's given not just to fintech, but to privacy. So in your proposed rulemaking on privacy, I guess I'm looking at the scope of privacy. You think about the key things for consumer protections, their data and the use of it has really defined a lot of this age, whether it's data breaches or the way that any number of companies have monetized the access to data that consumers have. So what's the scope that you're looking at and how do you use that to protect consumers?
Absolutely, Congressman. I believe you're referencing the Section 1033 policy discussion that we're having now about consumer authorized access to their own financial data. It is a complex issue. Certainly, the Bureau issued principles, and privacy and data security are part of that consideration for how best to enable that data access for consumers. We had a symposium a few months ago. We just issued the report out from that symposium and announced that we would engage in an advance notice of proposed rulemaking. I think it is a complex area. There are a lot of issues to consider that we're looking forward to getting more data on. But I would say that there has been progress made in moving away from screen scraping as the means by which many aggregators would get consumers' financial data using their bank credentials and having that be provided by the consumer. That's something that is not a best practice, certainly. And so moving in the direction of APIs so that there's an automated data transfer that can happen and that there is more control on both sides. But that's something that we are really looking to have a more extensive dialogue around, and that's what we announced last week.
Well, when you think about the consumer protections with respect to data, the work you're doing there is critically important in large measure because Congress has failed to act. We don't have a comprehensive data protection law for all consumer activities in the United States. We have a somewhat outdated Gramm-Leach-Bliley Act that I think you proposed to update, but there are lots of data houses that make use of this that aren't covered by Gramm-Leach-Bliley. So do you feel like you have the authority or scope to do everything that you would need to protect consumer data?
So, Congressman, you're raising an interesting issue here with respect to not just 1033, but more globally. We do have, I think, a number of issues around privacy and data security with standards in California and Europe and what happens in the U.S. And there are many parts of this that are outside the CFPB's purview. So specifically, the safeguards in the Gramm-Leach-Bliley Act are outside the authority of the CFPB generally. So that just to make you aware, I am actually looking at privacy and data security broadly and may have some requests of Congress or some suggestions around that. So I'm looking at that internally, particularly as it comes to credit reporting, because that's where we have at least a little more of an engagement and a responsibility there, particularly as it comes to our supervisory work. But I'll certainly get back to you on that and others. I know it's of great interest. But with Section 1033, we do have the ability to take this into account as we think about how best to move forward in that.
Thank you very much for your attention to it. There's really no excuse for Congress's failure to provide this safeguard for all America's consumers. And I hope that I can collaborate broadly for a good bipartisan solution on privacy, not just with respect to government, warrantless surveillance and things like that, but consumer financial data. Our seniors are especially vulnerable, and I appreciate the work you're doing to safeguard our seniors. And I think the last thing I'd say is, as you have conversation with the members of SDOC, with our Treasury and everything else, most of America has their assets in US dollars. It is the store of value. It is the means of exchange. And this idea that we can, in an unlimited way, just continue to print money and not damage the value of all the other dollars is foolish. We've printed an awful lot of money. We haven't truly borrowed it because there's not a real lender. And, I just urge you to weigh in where you can on the importance of protecting the US dollar as a store of value and means of exchange. And for that purpose, my colleagues and I recently formed the Sound Money Caucus. Thanks again for what you do to protect America's consumers. And I yield.
The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Director Kraninger. I think I'd probably speak for all of us on this committee saying that when I woke up this morning and was going through the news headlines, was completely gobsmacked, for lack of a better word, to see that the GDP has collapsed by almost 33% in the last quarter. That is well outside the range of challenges that I anticipated I was going to be grappling with when I was asked to serve on this committee. I suspect, Director Kraninger, it's probably outside the scope of yours as well. As the old Monty Python skit says, nobody plans for the Spanish Inquisition, right? I think all of us knew it was going to be difficult. We did have leading indicators. Your own bureau, in the case of leading indicators, is unfortunately the case when the economy gets tight, unscrupulous actors emerge, and as Congresswoman Tlaib was calling out, I think you saw an all-time record for consumer complaints at the department in March, which was then topped in April. A new record was set in May. A new record was set in June. During the Q2, you're basically running about 50% above historic complaints at the CFPB. In spite of that, you've had 13 public enforcement actions this calendar year, which basically puts you on track to finish about at the level of 24 that you did last year, which, as the Wall Street Journal has reported, is down 80% from the 2015 peak. My question for you is that why has the CFPB decided against taking enforcement actions, despite the rise in complaints that Americans are feeling during this economic downturn?
Congressman, we are taking robust action using all of our tools, and certainly that includes enforcement. So I would ask you to reserve judgment until we actually get to the end of the year and see where we end up. I will not manufacture enforcement cases, but I will take the right action against bad actors. And we do have a number of actions in the pipeline that I have authorized that I expect to see move forward. So I will at least note that.
I want to just hang on, because you said to Congresswoman Tlaib that you are averaging 9 days between when your complaint comes in and you respond. I just gave you data going back to March that's 50% up. You're saying you've gone through, you've gotten back to people in 9 days, but you haven't decided what to do with that yet?
Oh, Congressman, the complaints are different from enforcement actions. So the complaints do get resolved in 9 days on their initial response.
Okay, so on April 1, your Bureau issued a statement which said in part, hang on, the Bureau specifically states that it does not intend to cite an examination or bring an enforcement action against firms who exceed the deadlines to investigate such disputes, as long as they make good faith efforts to do so as quickly as possible. It sounds like you're saying you are not taking enforcement actions. The data would be consistent with that. What motivated you to issue that guidance?
So you're specifically talking about credit reporting, dispute resolution, and we had, the dispute cannot be resolved if the small business merchant, for example, is actually shuttered and cannot respond to the credit reporting agency. So that's what the good faith effort is about. Absolutely, the mandates to respond remain in place and they need to be met. But there are extenuating circumstances like the closure of a small business, for example, that's a merchant that is the subject of the dispute.
I'm pretty sure your job is to protect consumers. What are you telling consumers who are sitting there saying, I need a response? You got a 50% surge in consumers, and what are you doing? You're calling them back and saying, I'm sorry, I just can't address this. Figure out how to pay your own rent. Figure out how to pay your medical bills. Figure out how to pay your car payments. The title of your agency is consumer.
Well, Congressman, there are remedies that come after that particular example that I gave you. So it is not acceptable not to respond. And I noted to Congresswoman Tlaib, as you noted, that we do actually get initial responses in the vast majority of complaints, and on average, it's a 9-day response. But there are responses that take a little longer.
Let me just close the way I started. All of us in this hearing, yourself included, are entrusted with looking after the public interest. When these circumstances arise that are way, way outside of the range of situations that we would encounter, we have an obligation to make sure that we're adjusting our tools. There's a reason why the captain goes down with the ship, because the captain's got to look over the safety of everyone on the ship. I would hope that you are seriously looking at what your agency can do better, because what you're doing right now is the status quo, which is 80% down from what it was when it was created. I think you know you can do a vastly better job. I yield back.
The gentleman's time has expired. The gentleman from North Carolina, Mr. Bud, is recognized for 5 minutes.
Thank you, Madam Chair. Director, thanks for being here today. I wanted to highlight a QFR response I received from your team. Excuse me. This was received from your team regarding a concern I have with the Bureau's marketing service agreement under RESPA. Now, there's still some need for clarification between me and my team as far as what we received, but you did indicate that you were willing to receive some feedback on this. Is it okay if we follow up with you after this on that issue?
Absolutely, please do.
Okay. I'd also like to ask unanimous consent to submit for the record a recent article on this issue, and it was actually authored by your former Deputy Director, Brian Johnson, and I'll be sure to share this with your team.
Without objection, such is the order.
Thank you, Chair. So a few questions, Director. In the NPR for the ability to repay rule, the CFPB encourages stakeholders to develop additional verification standards that the Bureau could incorporate into the QM safe harbor. Given the Bureau's important desire to move away from the static and dated verification standards in the Appendix Q to promote and foster innovation, how can industry and stakeholders help inform and define the Bureau's definition of qualified mortgages?
I think very much looking forward to the conversation around the standards, because it is a critical part of the ability to repay. Consider and verify debt and income is what the statute requires. We know that alternate data considerations, residual income as opposed to other means of assessing income. And we have a challenge in the current Appendix Q as well with respect to self-employed or gig economy workers. So understanding how industry has been looking at that, frankly, with input from all stakeholders, it's not just industry, but also consumer advocates and others who pay very close attention to what's happening in this space, how we can, again, bring forward creditworthy borrowers who are going to have successful loans. That's part of this. So we're very much looking to promote that and are welcoming engagement with all stakeholders, frankly, on what standards they would propose.
Thank you. I want to point to the CFPB's July 10th report on debt settlements and credit counseling. And it's in that you looked at the critical issue of options for consumers who just found out they've got more debt than they can actually handle. In this report, your agency found a rise in debt settlements since 2016, and even more significant increase in settlements that are facilitated by companies that actually charge the consumers to settle those debts for less money than they owe. Now, in my home state, in North Carolina, we've seen a rise in complaints about the practices of that industry. including misleading advertising, high fees, and that particularly targets the military, which is very concerning to all of us. So I want to encourage you to continue to look into this industry and take all appropriate actions to protect our troops and Americans who could be misled by false promises and high-pressure sales tactics from this industry. Any thoughts or follow-up on that?
Congressman, I would tell you it is an important area. We have taken a number of enforcement actions, including with state attorneys general against bad actors in this space. There are clear rules about their ability to collect any fees prior to actually getting the outcome they promised to the consumer. So that's generally where our actions have been taken, and we will continue to pursue that.
Thank you. So a priority of mine and of my committee Republican colleagues here is to eliminate costly and confusing regulations that make it more difficult for businesses to thrive and innovate for the benefit of consumers and markets. Particularly during this pandemic, when we are striving to get our economy back on its feet, it's critical to only promulgate clear, well-founded regulations. And that's why I believe that the failure to change the payment provisions in the small dollar rule will create a patchwork of inconsistent standards for payment provisions based purely on the consumer of the product. For example, some products will be judged by the standards of NACHA, others by the CFPB rule, and when Federal Reserve announces a payment standard, that rule will judge yet other products. This is particularly the type of regulatory mess that the administration has sought to eliminate. Would it not be better to undertake an appropriate study of the payment provisions rather than to ratify and implement the flawed findings of the 2017 Cordray rule?
Congressman, we will undertake a review, of course, 5 years after the rule is in place and take a look at how it is actually implemented. We did try to provide great clarity around which entities and which products are actually pulled into that rule. I know there were some questions about products that clearly were not actually even contemplated in the rule, so we did a lot with guidance on that.
Thank you. I yield back.
Thank you. The gentleman from Utah, Mr. McAdams, is recognized for 5 minutes.
Thank you, Madam Chair and Director Kraninger. When you first appeared before this committee last March, we had a discussion then about balancing access to credit while at the same time ensuring that consumers are protected from harmful products. Specifically, I asked about CFPB's planned actions on its payday rule, and I expressed my concern that payday products can quickly become debt traps, especially if a lender doesn't ensure that the borrower has the ability to pay. And you noted that it was a proposal at the time and you would continue to review your consumer protection mission as you undertook the rulemaking. So earlier this month, you issued a final rule that repeals the requirement that lenders determine a borrower's ability to repay those loans before making them. So I'd like to ask you again, what role does consumer protection play as you undertook and finalized this rulemaking?
So, Congressman, the mandatory underwriting provisions were very specific. So I recognize they're frequently referred to as ability to repay, but there were specific stipulations there that would be particularly challenging. Again, by the Bureau's own estimation, it would have a significant reduction in the availability of credit there. So that was something that we looked at.
Yeah, I would just say from my perspective, it seems like you just made it much easier to have consumers get trapped in that cycle of debt that they would be cycling through over and over again. And I worry this rulemaking sacrifices reasonable consumer protections. And I know it's a balance, but it seems like the balance is against the consumers. And as I understand it, part of your assertion for repealing the mandatory underwriting provisions is due to what you claim is insufficient research that went into the 2017 rule. Is that correct?
Yes, Congressman, as well as the legal reasoning that was in that rule.
So I would like to read you a footnote in your rulemaking from this month. It's footnote 343, buried on page 171 of the PDF, and it says, consumer protection issues have arisen and will continue to arise in the payday market, as in other markets, as a result of a given lender's specific practices. And the Bureau is prepared to address those issues, for example, through supervision and enforcement against deceptive claims in advertising or marketing for payday loans. So you've acknowledged in your own rule that there are consumer protection problems in the payday industry. And I would ask, is your contention that supervision and enforcement are sufficient tools to keep consumers safe?
Congressman, they're certainly part of the protections that are in this space as in others. I have contended that there are bad actors in every market space,
Sure.
including this one.
Sure.
So they're a key part of it. I'd also say that we are doing work on disclosures because I think there's great evidence in those rulemakings that there are consumers who well understand the products, and there might be some who don't quite understand the products when they actually get them. And that's something we want to look into and are doing disclosure testing on. So it's another example of another protection in addition to the payments provisions and supervision and enforcement.
Thank you. Well, I think if we are putting a lot of stock in supervision and enforcement as our means of protecting consumers in this regard, I'd like to see what your plans are for beefed up supervision and enforcement plans. And if not, do you intend to study the issue to put together sufficient research and pursue regulations that actually do keep consumers safe, which is the mission of the CFPB?
I am committed to constant review of the rules. We have 5-year look-back requirements by Congress that I think were incredibly, there's a lot of foresight in those. So we will definitely do that on this rule as we do on others, for example. But any feedback based on what is happening in the marketplace needs to inform the way we operate.
But as it stands right now, even though you acknowledge that there are consumer protection issues, you are not looking for any additional tools that would help to protect consumers in regards of this debt trap in payday loans?
Our disclosure testing would represent that. I'd also note increased competition is part of what we are seeking, and we have been working through our innovation policies to get banks and credit unions to offer responsible products in this space too.
Okay. Well, I would like to see what research was used to base that conclusion that would be adequate and sufficient for consumer protections. Lastly, and we're about out of time, so maybe we'll just submit this in a written form, but on Friday, the CFPB announced that it plans to release an advanced notice of proposed rulemaking on consumer authorized access to financial records. This is a topic that this committee has explored before, and it's of great interest to consumers, to financial institutions, and to fintech companies. So I'd love for you to elaborate on the CFPB initiative and what the Bureau's goals are with the ANPR and rulemaking process. And I do see that we're out of time, so we can take that outside of this forum. But thank you, and I yield back.
Thank you. The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you for convening today's hearing. Director, thank you for appearing today. If I could, I'd like to follow up on Congressman Budd's question towards the end of his questioning. I know about 3 weeks ago you did finalize the final rule as it relates to these payments and the small dollar lenders. So the rule that you promulgated 3 weeks ago or so kept in place the 2017 rule provision that imposed, frankly, a restrictive requirement by allowing just one representment of a returned ACH payment. And it also extended the representment limit to transactions not covered by the NACHA rules. So my first question is there a disparity in that the NACHA rules shouldn't be applied to all lenders?
Congressman, we were starting with the rulemaking we had in place. And so the mandatory underwriting provisions were the ones that had the significant impact on the availability of credit as well as the issues that we've been discussing here today. And so the insufficiency of the evidence and legal reasoning that underpinned that part of the rule. So that is where the reconsideration came into play. It was my judgment that the payments provisions, again, should continue, that we can see how that is implemented. And as I just said to Congressman McAdams, too, we can certainly look at what happens and if there are unintended effects to it. We did also put out some very clear guidance to try to stipulate what products are affected and what are not. And I appreciate the point you're raising. It's the rulemaking that was promulgated, and so that's the process we engaged in.
All right, let me ask it another way. Doesn't the final rule create more burdensome regulations for just some covered lenders?
It does only affect certain lenders. That is very true, and that was certainly by design of the rule. And we will certainly take into account what impacts that has when that is able to be implemented.
All right. Are there plans to revise the payment provisions in the future, or is it your position you have to wait 5 years?
Congressman, I certainly respond to things that we see in the market. So if we get evidence sooner that there is an issue that needs to be dealt with, I would be certainly happy to consider that.
Thank you, Director. If I can, I was reading a report from Yahoo Money last week that talked about 1 in 4 Americans with credit cards said that they had an account involuntarily shut down during the span of May to July. And specifically, we're talking about, or the article talked about, those consumers with FICO scores between 550 and 700. I think that article said that that roughly covers about 60 million Americans. So I think we all know that the credit card for so many Americans, it's not just a lifeline, it's a necessity. Are there any steps that the CFPB is taking, and I'm talking about specifically for those consumers in the 550 to 700 credit scores, so that they don't lose their credit cards due to the pandemic?
Congressman, you're raising an important issue. I'm certainly aware of credit limit changes and certain cards that don't have activity on them, but I was not aware of the article you just cited, so I'm happy to take a look at it and see precisely what happened there and what action we should take.
Thank you, Director. And with that, I yield back the remainder of my time.
The gentlewoman from Virginia, Ms. Wexton, is recognized for 5 minutes. She needs to unmute. Ms. Wexton, please unmute.
There we go. Better. Okay, now I've got it. Thank you. Thank you, Madam Chair, and thank you, Director Kraninger, for joining us today. Now, Director Kraninger, I did read your extended testimony, and in 14 pages, I saw just one reference to the Paycheck Protection Program, which I'm sure is something that you guys are very much involved in at this time, as it's such a timely program and doing so much work here in our country. And you do have a role in supervising the implementation of that program, do you not?
Only a narrow slice of that, certainly with respect to the Equal Credit Opportunity Act compliance by covered lenders.
Right, so you do have to manage and make sure that you have to assess the compliance of lenders with fair lending laws, right?
Yes, with ECOA, yes.
Are those assessments taking place, and what have you found about Paycheck Protection Program loans?
So we are engaged in what we're calling prioritized assessments, so very targeted exams of entities with respect to what's happening right now. And we did include small business lending, ECOA compliance as part of that effort. So we are engaged in that now.
So let me ask you, even if you can just ballpark it, what percentage of Paycheck Protection Program loans went to minority-owned small businesses?
Congresswoman, off the top of my head, I don't know the answer to that question. I do know it's an area that, again, I am interested in generally, that the administration has been interested in promoting, and we've done a lot of outreach to try to expand that availability.
So I don't suppose that you can ballpark what percentage of Paycheck Protection loans went to women-owned small businesses either?
No, I cannot.
Okay. Well, an Inspector General report from May criticized the SBA for not requiring applicants to submit demographic data. I'm sure you're aware of that. And my colleagues and I have repeatedly called on the SBA and Treasury to collect this information on loan or the loan forgiveness application and make it mandatory, but so far it's only being collected on a voluntary basis. And that's concerning because in my district, we performed an assessment of our own of those applications put out there in Virginia 10. And in my district, 95% did not provide the race or ethnicity data, and 83% did not provide gender ownership. So Director Kraninger, it's probably a lot harder for you to do your job if you don't have the information demographic data to do your assessment with. Is that correct?
Well, there were certainly other issues at play with trying to move quickly and get this program running. So I will say,
I get that, reclaiming my time. I understand that time was of the essence and everything, but it's hard for you to do your job if you don't have the data. I think you would agree about that. I know you don't work for the SBA or Treasury, well, I guess a little bit Treasury, but have you communicated with them about their decision not to require demographic data for collection of Paycheck Protection Program on either the application or the forgiveness application? Have you communicated with them?
We have talked about the data that is available in terms of what the reach of the program has been and the extensive number of small businesses that it has helped. We are continuing to look at how we can promote, again, access, which is the core of your question and certainly the core of my interest, and understanding that better. And that's part of why we engaged in the prioritized assessments too.
How are we going to know what kind of access has been provided when 95% of the people, at least in my district, aren't even answering the question? So that makes it very difficult. Now, you are responsible for implementing Section 1071 of Dodd-Frank, right?
Yes.
And that does require that lenders collect and maintain information about loan applications by women-owned, minority-owned, and small businesses, and that requires the CFPB to collect and publish that information. Is that correct?
Yes, that is correct.
But your leadership under the Bureau, under your leadership, has slow-walked the implementation of this section. And in February of this year, you settled a lawsuit seeking to compel you to implement the law. Is that correct?
No, that's actually false. I committed during my confirmation process that was a statutorily required regulation, and I was committed to implementing it. And I actually announced that in the regulatory agenda prior to the filing of the lawsuit.
But you entered into a settlement that had court-ordered implementation deadlines. Is that correct?
That is correct.
And have you started the rulemaking process?
Yes, we will issue a SBREFA outline, which is the Small Business Regulatory Relief Process outline by September 15th, and engage in that part of the regulatory process this fall.
And you commit to meet your deadlines under this section?
Yes, that's the only deadline at this time. Thank you.
The gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Hi, good afternoon, Dr. Kraninger. Thank you for being here, and thank you for your continued work at the CFPB. I'm sure at times today, a 1/4 of an inch of plexiglass hasn't seemed like enough protection. I wanted to step back and talk more generally for a second about some of the larger dynamics at play in our economy and certainly at the CFPB as well. You recently published a blog post, or I should say the CFPB generally recently published a blog post about the use of AI and ML increasing in financial protection laws. I wondered if you might venture into, or do you intend to do more in this space? What might that look like? What are you trying to balance in terms of your next actions in that space?
It's a great question. I think what we were seeking to do with the look that we've done at AI and ML and also alternative data in underwriting is the recognition that there is great opportunity there in terms of expansion of access, particularly for underbanked, unbanked individuals who have not been reached before. So taking that information into account. There's also some risk introduced in that process, again, so understanding it. So we're continuing to look at how lenders are approaching that, looking at what innovations they're bringing. Our innovation policies are an opportunity for them to engage with us and look at either a sandbox policy or a no action letter policy to have a more robust conversation about that and then have data from actual operations by an actual lender or creditor to base any additional action on. We're certainly looking at it with respect to our supervisory activity, enforcement activity too, but I think largely it's making sure we have experts inside who understand how it works, understand how industry is seeking to apply it, and looking at how that is hopefully being beneficial to consumers and taking action where it is not.
Yeah, Director Kraninger, I think that is extremely well said. There are tremendous opportunities. There are also limitations of the technology, certainly, but tremendous opportunities to increase inclusion in the financial sector and empower Americans. in our district and many other districts across the country to be able to live better lives and achieve their American dream. And I think you would agree with this, but to hear you say it, it sounded like you also said there are real costs to retarding innovation in this country, retarding financial inclusion in this country to families, their lives, their futures. Is that true?
Yes, I do see that.
And something that you will weigh as you continue to think about, A, what that sandbox might look like, how we increase perhaps the pace of innovation while also recognizing the safety that needs to go into place as well.
Yes.
Great. Second question, again, generally, I know my friend across the aisle, Ms. Wexton, touched on prioritized assessments. I wondered if you might talk a little bit about what you've learned in some of that, about how our financial institutions have been able to serve their customers, help their customers, empower their customers during the course of the last 4 months.
Yeah, that is certainly what I expect to find in the vast majority of the prioritized assessments is precisely that, and understanding, getting, again, some more information about how that is going, what practices are successful for consumers, and what activities or what challenges are those institutions facing in trying to help their customers.
And I'm sure
we don't have much at the moment, but we're literally in the midst of it right now.
Right. I'm sure not all of their challenges are policy related, but some of them may be policy related, regulatory related, to ensure that they have the flexibility to be able to serve those customers, not just during more ordinary times, perhaps, more ordinary circumstances, but also the flexibility to address their customers' needs during extraordinary circumstances as well. So providing some of that latitude and flexibility, I imagine, will be an important learning point going forward, right?
Yes, definitely.
Great. And then in addition to that, I wanted to ask about further coordination in some of these exams done by multiple agencies and making sure that a company or an institution is providing that information as few times as possible and is disseminated as widely as possible as needed, not overly disseminated, by the way, within the reaches of the federal government.
Yes, that is something that has been a focal point for me as the chair of the FFIEC, where we're coming together and coordinating on exams. Despite the challenges of the pandemic and other priorities that do supersede this, we have a continued activity going on around common technology and common data collection and sharing. So that is still happening. We're still looking to make some progress on that.
Right. Obviously, institutions are rightfully concerned about the proliferation of hours that are being used in submitting to exams, which they are ready and willing to do, but also want to make sure it's coordinated and done as efficiently as expected so that they can spend their time serving, helping, empowering those customers. And with that, I'll yield back.
Thank you. The gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes.
Thank you, Madam Chairwoman, for having this hearing, and thank you, Director Kraninger, for appearing and helping us with our work. Director, last week, CFPB announced an advance notice of a proposed rulemaking around Section 1033 of Dodd-Frank, which obviously deals with the consumer authorization of access to financial data and records. We recently had a hearing on this issue, and I'm following up on Mr. Davidson's concerns. We recently had a hearing on this issue in the Financial Services FinTech Task Force, and the concerns were largely in two areas, and they were bipartisan. First of all, people were concerned about, members were concerned about the full spectrum gathering of data from consumers, and whether that happens from screen scraping, which you mentioned, or web scraping, content scraping, or whether it's telematics. You know, right now, through our cell phones and other technology, financial firms and others know everything about our lives, who we are with, where we travel, how fast we drive. And those tools can be used to discriminate. We've seen in some instances where individuals who live in a certain census tract were discriminated against because they lived in a low income or in public housing. So that was one concern about the use of that data and the practice of screen scraping in particular. The other issue was the consent form, the so-called consumer consent. And, you know, you've got a 19-page consent form that basically the application administrator requires you to sign off on this 19-page item that even as an attorney, I had a difficult time understanding, and that's for regular consumers. So 2 questions. One, where are we on screen scraping? You mentioned we're moving away from screen scraping in your earlier comments, but we've been moving away for over a year. We're just not moving that fast. And secondly, the issue of those consent forms, are you thinking in this rulemaking that you'll address both of those aspects? And I just love to get your insights and your thoughts on both of those issues. Thank you.
Thank you, Congressman. I'm glad you all had the opportunity to talk about that and take advantage of that ourselves. We had our symposium where these issues came up, and the purpose of the advance notice of proposed rulemaking is to really formalize that data gathering and think about what might be needed in a rulemaking and what would make sense. But the 2 issues you raise are important ones, certainly. One with respect to what kinds of data is actually available and how it gets used, and then certainly what consumers know about the data that they have permissioned and how it's going to be used. And the disclosure aspect of this, the consent process that you noted, is one that's of concern to me since I've been in this position, and we're going to make some progress on trying to do better disclosures and give people the key information they need rather than giving them legalese that they just end up checking the box on. So that is a huge, I think, concern on many fronts. Please, go ahead.
No, just on screen, you started to address that earlier, but you were cut off.
Oh, yeah. So with respect to screen scraping, the we, of course, is the marketplace at this point in time. The Bureau certainly would intervene in UDAP circumstance or other compliance issue, but the market really is moving away from that. So there have been a number of agreements on API means of sharing that are making progress, and some real deadlines from financial institutions insisting on APIs or shutting off access. I won't comment, frankly, on there are issues with that for sure on both sides, but I do think there's been actual progress made to reduce the screen scraping. So that's in the marketplace generally.
And what about the length and complexity of these consent forms?
That is a concern area. It's something that we will take feedback on and see what we can do about that, or what would require rulemaking, what might be able to be addressed in other ways. So that's what the ANPR will do.
All right. Thank you, Madam Chair. Thank you.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Director Kraninger, for being here today and for your continued service to the country. I applaud you and your staff for continuing to work on behalf of our country during the pandemic. It's not easy for anybody, and you all have performed well, so thank you for that. As you know, there's growing evidence that one of the best things regulators could do to expand credit access is to make it clear that lenders are allowed to use new underwriting techniques that leverage alternative kinds of data. Mr. Hollingsworth referenced this as well. Traditional credit scores are generally good predictors of risk for people who have high scores, but they don't work for people with little or no credit history. Not for many people who are creditworthy but have lower credit scores due to complex factors that the scoring process does not capture. Fintechs and some banks have been innovating in use of non-score factors now that it's easy to capture new kinds of data and can be analyzed with techniques like machine learning. Research by the nonprofit FinReg Lab and others supports the argument that these methods are predictive of risk. However, the industry, especially banks, have hesitated to adopt the methods because of concerns about regulatory criticism and especially the potential to run afoul of the prohibition against unintentional discriminatory disparate impact. You and other regulators have issued joint encouragement that lenders consider these new methods but have not yet offered clarity on how to do so in ways that regulators consider inside a green zone on disparate impact. First question, do you see this innovation as a high-impact way to expand credit access? I think the answer is yes. You sort of elaborated already, but just to say it again.
Yes, yes, great. I do.
And then what plans are you currently working on to clarify the rules of the road to encourage faster adoption here?
So, Congressman, I'd point particularly to our innovation policies, having that opportunity to have engagement with an entity, understand the product. They have to provide the benefits that they see to the product, to consumers, the risks that they see, the way they're mitigating those risks, and what regulatory issue is a barrier or is a challenge. And we can have that dialogue about that product and be very specific about the ability to move forward with that product with guardrails. So that's certainly the top avenue. We are looking at what additional guidance would be useful. We've issued guidance on alternative data. We did on AI and ML use in underwriting. And I think we're very open to that in terms of the conversation. I did issue a request for information just 2 days ago on the Equal Credit Opportunity Act, and it did specifically ask about alternative data and other issues that might be posing challenges to entities, or where we think there might be opportunities. So response to that is also could lead to different action.
Thank you. And then is there anything that we can provide at the congressional level that would empower you even more to sort of help set up the guardrails here, and other regulators generally? Yeah.
Congressman, I don't have anything at the moment that I would seek or suggest, but appreciate the question, and we'll certainly let you know if we do find something that would be useful.
Okay, thank you. Because I think, like a lot of my colleagues, one of my biggest fears coming out of this pandemic is, and you can just see this looking at what's happening in the markets, for very wealthy people or people in the upper income scale, it's inconvenient but not financially devastating, certainly not. For people who are lower income, especially minority communities, it's absolutely devastating, setting them back even further. And so I see alternative data sources and different ways of expanding access to credit as one of the most important things we can do, because people are going to have to rebuild their lives. And we have to provide them with all the opportunities necessary to do that. So I'd encourage you to keep that work alive and to keep interacting with us if we can provide help, because people are going to need it. And with that, I yield back.
Thank you. The gentlewoman from North Carolina, Mrs. Adams, is recognized for 5 minutes.
Thank you, Chairwoman Waters, for convening today's hearing. Thank you, Director Kraninger, for being here. I wanted to ask a few questions regarding predatory debt settlement companies and the harmful settlement activities that are happening in my state, likely also happening across the country. In North Carolina, we've seen a rise in complaints about the practices of this industry, including misleading advertising, high fees, particularly from the military and their families. I've gotten letters from high-ranking officials at Camp Lejeune and Fort Bragg in North Carolina, from one of our largest credit unions, the State Employees Credit Union. So yes or no, have you heard of a company called Freedom Debt Relief or Freedom Financial Network?
I have not heard of those companies specifically, Congresswoman.
Okay, what about you? So you're not aware then of their business model of predatory practices then, if you're not familiar with the practice?
I will say that the concerning practices by some debt settlement companies is definitely something that I am aware of, and we have engaged in enforcement actions. I believe with the state of North Carolina, with the Attorney General of North Carolina. I believe he was a party to that, to one of those cases. So there are concerning practices happening there, and we are taking enforcement action.
Well, thank you. But, the CFPB under Mr. Mulvaney brought an action against the Freedom Debt Relief and secured about $20 million in restitution, $5 million in damages, violated the law by charging customers or consumers without settling their debts as promised. But are you aware that the CFPB entered a consent order with the Freedom Financial Service after the agency filed this complaint?
Congresswoman, I do apologize that I don't remember that particular case, but I stipulate that you are probably right.
Okay. Let me ask you, if do you believe that it helps consumers when debt settlement companies encourage customers to customer borrowers to deliberately default on credit card debt? Do you think that helps consumers when they do that? Yes or no?
No, there are many concerning practices in the debt settlement space. There's no doubt. So we are certainly paying very close attention to that and taking action. They cannot, accept fees when they have not actually provided the results, and there's a requirement to actually do that several months after the outcome they promised has been delivered.
Okay. In this time of COVID, with an economy that's hurting, it's very likely that our constituents will find themselves saddled with more debt. So I want to know what you and the CFPB will do to protect American consumers and our military from being misled by false promises and high-pressure sales tactics from the for-profit debt settlement industry, because they're really leaning hard on these folks.
No, I agree with you. It is a concerning area. I can say we're also working with the Department of Defense. In addition to all of our enforcement actions, we are working to make sure we get information to those military personnel, to consumers generally about being cautious in the debt settlement space, and frankly pointing them also to nonprofit entities where they would get the support that they may need.
So let me ask you, in terms of smaller lenders, they are probably finding it more difficult to compete in this kind of environment. Several industry groups and consumer advocate organizations have also expressed concern that a pricing-based definition could result in a race to the bottom. Based on the Bureau's own recognition that pricing can be manipulated, the proposed qualified mortgage standard does not appear to be an effective measure of a borrower's ability to repay. So how will you ensure that a pricing-based qualified mortgage does not incentivize irresponsible mortgage lending, similar to what we witnessed in the lead up to the 2008 financial crisis?
Congressman, I appreciate the question. It's an important one. The statutory features that are precluded from being part of a qualified mortgage, that continues. In addition, a requirement to actually consider and verify debt and income is part of the law. So,
all right. Thanks very much. I yield back, Madam Chair.
Thank you. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry, for holding this hearing, and thank you, Director Kraninger, for appearing before us today. I'd like to jump right into the CFPB's recently finalized small dollar lending rule. The Bureau has previously acknowledged the key role that small dollar loans can play in helping consumers meet credit needs, usually resulting from unexpected expenses. At the beginning of this month, the Bureau took a step in the right direction by rescinding the mandatory underwriting provisions of the Obama-era small dollar lending rule. However, like several of my colleagues, I am very disappointed that the CFPB chose to leave the payment provisions of the original rule intact. Much like the ability to repay provision, the Bureau's own evidence didn't support its payment practices provisions. They were flawed and based on unsupported data. It also imposes onerous requirements that could make it all but impossible for consumers to use recurring payments. I want to get a real answer to this question, Director Kraninger. Please explain to me why you kept this particular provision in place, choosing to enforce an Obama-era rule requiring overly burdensome compliance.
Congressman, I recognize that that is an important issue for you. It's been raised by many members. First and foremost, it was the reconsideration of the mandatory underwriting provisions that really were the focal point, given the dramatic impact that would have on the availability of credit in this space. So that was the priority. With respect to the payments provisions, it was also a recognition that there is some consumer protection in there with respect to certain products. I recognize there were also concerns about how broad this may be applying, and we did issue additional guidance when we issued the final rule that laid out the types of products that are covered, are not covered under this rule to try to address some of those issues. And the last thing I would say that I have not mentioned earlier is that we're still in litigation over these provisions. So that is still ongoing.
Since we last spoke about this, I know you were looking again at this provision. However, it remained in the final rule published on July 7th. How long are lenders given? How long will lenders be given to comply with this payment provision?
So because of the litigation, the rule is still stayed. The Bureau is seeking to propose to the court that it lifted after a reasonable period of time. Since we have not done that filing, I can't tell you here what the reasonable period of time is, but that would be my intention. And that filing should happen relatively soon. So we can answer that question for you relatively soon.
So once that filing occurs, would you expect it to be 60 days from that time?
I am looking at a reasonable period of time, and I can't tell you right now precisely what that will be, but we'll get back to you.
Keeping this provision in place will cause, in my view, an undue compliance burden on financial institutions and payment processors. Ultimately, the end result will be that responsible lenders unable to manage and mitigate the risk will choose to de-risk and quit or not form relationships with companies offering covered loans, increasing the cost of these products to the consumers that need them. This will also drive the small dollar lending market back to the storefront payday lenders, putting us in the position of picking winners and losers. Moving forward, I believe it is crucial that we maintain consistent payment system rules, which are grounded in associated laws and regulations. And I urge you and the CFPB to revisit this finalized rule and roll back the payment provisions created by the 2017 small dollar lending rule. In my remaining time, I want to just turn to another issue. Back in January 2017, under Director Cordray, the CFPB filed a suit in federal court alleging that hundreds of thousands of student loan borrowers have been harmed by steering borrowers away from income-driven repayment and toward costlier options. In nearly 4 years, how many borrowers have been proven to have been steered?
Congressman, that's ongoing litigation and obviously in the midst of discovery and other parts of that process there. So I can't answer that question for you, but I understand why it's important.
I am very concerned that this ongoing litigation that you describe without discovering any evidence is a bad use of taxpayers' dollars. And I am concerned that the CFPB is dragging out cases like this in search of a problem in order to justify the sunk costs that have already been incurred. I hope this practice does not continue. With that, Madam Chairman, I yield back.
Thank you. The gentleman from Illinois, Mr. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member, for convening this hearing, and thank you, Director Kraninger, for joining us today. Congress passed Dodd-Frank and authorized the Consumer Finance Protection Bureau 10 years ago this month. In 2010, our country faced high unemployment. Millions of people lost their homes to eviction and foreclosures. My community was hit hard by the last financial crisis, and many people never recovered. And now COVID-19 crisis has left my constituents piled with housing debt, medical debt, credit card debt, and who knows when they'll get back on their feet to pay it off. That's why the CFPB was established during the last crisis to give ordinary people like my neighbors in Chicago their own voice against big banks, against mortgage lenders, against debt collectors. But that's not what we see from watching the Bureau today. During a nationwide pandemic, when we have no idea when jobs can come back and consumers have no idea how they're going to pay off their debts, the CFPB has been working for industry instead of the public. Gutting the payday lending rule earlier this month is a scary example. Cutting the payday, I represent a working class immigrant district There are a lot of payday lenders in my district, as lobbyists always like to point out. The CFP, this is a question for you. The CFPB's new rule eliminated the requirement that lenders ensure that the borrowers can pay the loan back. This means that a lender can now make a loan when they know that a borrower cannot pay it back. Director Kraninger, do you think that a lender should make a loan to a customer if they know that they cannot pay it back?
Congressman, the mandatory underwriting provisions of the small dollar rule had.
Can you give me a yes or no answer, Director?
I'll just say the small dollar space is a little bit different, and that ability to.
Should they make such a loan if they know that it can't be paid back?
Congressman, I appreciate the principle.
Okay, you won't answer that. Are you worried about trapping customers in a cycle of debt that they aren't able to repay?
Congressman, again, I appreciate the principle you're trying to establish. This is a complex area.
Are you concerned about that?
I absolutely want to make sure that consumers understand the products that they are.
Are you concerned about it?
I want consumers to understand the products that they're engaged in, and I want them to have options.
Let's move on if you don't want to answer those two questions. The Military Lending Act protects our service members from getting trapped in a cycle of debt by setting a 36% interest rate cap on their consumer finance products. I introduced the Bipartisan Veterans and Consumers Fair Credit Act to extend the cap to all consumers so that all of my constituents enjoy that protection. Do you support the 36% interest rate cap currently in effect under the Military Lending Act?
It is current law, Congressman, so that is.
Do you support it?
I don't have a role in examining that, but certainly we enforce it.
Do you think that the rate cap helps service members avoid being trapped in a cycle of debt?
Congressman, I believe that Congress put that in place for a reason that's outlined in the.
Do you think it helps them? Your opinion, not Congress's. Undecided. Okay, my last one. Director, some of my colleagues across the aisle seem to be mistaken by the recent Supreme Court decision in Saylor Law versus CFPB. I want to clarify that the Supreme Court did not rule that the CFPB itself was unconstitutional, but that only the requirements needed to remove the director was unconstitutional. So my question is, does this case in any way limit your authority or ability to protect consumers moving forward?